We think we're sitting towards the top end of a very strong rally.
The Fed has made significant inroads in the battle against inflation.
What's left behind is a lingering higher inflation rate than we would like.
I think that the Fed isn't done, and I still don't think it's going to cut rates quickly.
If I were a voting member of the FOMC, I would vote for wait and watch.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
It is Fed Decision Day, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market positive by 0.1% on the S&P 500. This hiking cycle started on March 16th, 2022. The S&P 500 that day closed at 43.57. This market yesterday, Tom, closed at 43.69.
Well, we can skip to it and go to the Fed meeting. We're going to pause and try to figure out what the markets are signaling right now. And there's a lot of ambiguity here. It's ambiguity Fed day. I can't figure out, John, what the markets are signaling in terms of conventional language. The conventional language is out today. People are telling me this is going to be a snooze fest, and all my radar's up, because usually when it's a predictive snooze fest, that's when a chairman can message to Michael McKee late in the press conference.
Think about what we've thrown at this equity market over the last 18 months or so. 500 basis points of hikes, Lisa. 3 bank failures in the United States of America. We've had a bear market, recovered it all. Amazing.
It's important that you mentioned that this began on March 2022. Are we now reaching the end? Is this meeting going to basically signal the end of the rate hiking cycle? And that is what people are wondering. And it's now when the pain begins. And to your point, we haven't seen it yet, given the fact that equity markets are higher. Now, do we start to get the slow bleed that was intended all along?
Foundational chart, I put it out on Twitter earlier this morning. Nick the Whisperer over at Wall Street Journal has a spectacular chart. And on a Newtonian calculus basis, you nailed it, Lisa. We've gone up at a steepness, an elevated rapidity of yield curve, of yield increase, and we haven't even hit the first derivative. We haven't even turned around. We need 1 meeting, 2 meetings, 3 meetings to get that vector that's a legitimate pause. We're not there yet.
We haven't seen the pain in the labour market. Let's be clear on that. If you think about when the hiking cycle started of March 22, in April 2022, that was the last time we had a downside surprise on a payrolls report, Bramo. The labour market stood up to this pretty well so far.
What I find interesting is the shift in inflation dynamics. First, it was supply side driven. It was the fact that people had money and all wanted to buy stuff. And now it's moved to the labour market. And that seems to be the theme, not only from economists in the market, but Bernanke, as well as Olivier Blanchard, who put out a paper on this. But this, to me, how do you end up with a soft landing if you need to see the dynamism in the labour market cool down much more materially than it has so far?
Does the word skip get into the statement today? Do you think they use that word?
No.
We're skipping today? We're skipping.
It's not.
Doesn't sound very professional, does it?
No.
We're skipping today's meeting.
I mean, are they going to say pause after all those sort of hand wringing? Are they going to say pause?
Well, this is a serious question, because this is all financial media talk. Forget about it. What we've got
Hang on a minute. Let's not. It's their talk.
Skip. Okay, yeah, but I don't care about they. I just care about what happens at the meeting and then the press conference. And my answer is we're having a healthy discussion about the symmetric or asymmetric effects of stopping. And there's a belief. Matt Lazzetti sat right here with Deutsche Bank and said, no, if they pause, it's a vector towards rate decreases. Others disagree. Bill Dudley says it can be symmetric and you can still move higher. That will be what we'll have to listen for today.
Today is a 3-part act. You get the statement, you get the projections, you get the news conference with Chairman Powell. Going into all of that, your equity market looks a little something like this on the S&P 500, just about positive on a 4-day winning streak on the S&P coming into Wednesday, up by 0.1% this morning. In the bond market, yields just about unchanged on a 10-year maturity. Lisa, 380.75.
Stasis, a bit of calm ahead of the key events of today, which begin at 8:30 a.m. U.S. PPI following the CPI report that we got yesterday. The expectation is for it to cool down because this is the stuff prices, basically not necessarily the services prices, but the manufacturing inputs. How much does it decelerate, and does it matter? Because people are looking past this to really the services-induced inflation. At 2 p.m. is the FOMC rate decision, followed by Fed Chair Jay Powell. We'll be having a news conference at 2:30. I am sure he will mention the word skip. He might even directly message it head on. And John, you were talking earlier about the potential for dissent on the margins, as well as potentially a shift in the dots. Are they going to signal higher for longer longer and potentially a slower bleed in the economy. And at 1:30 p.m., we're going to be kicking off our special coverage, which will continue until after the press conference. Randy Krosner, former Fed Governor, Matt Lazzetti of Deutsche Bank, Michael Collins of PGIM Fixed Income, as well as Seth Carpenter of Morgan Stanley. John. The
team did a fantastic decision day guide here at Bloomberg. I didn't realize the last dissent from a Fed governor, 2005.
I had no idea. I would never have guessed that.
I did not know that.
Isn't that amazing?
I think the British do it so much better. I love the way the British do it.
Plenty of Fed presidents have dissented, but
this is a legacy, I'll say, from
like
Greenspan. And
the board just does the same thing. Amazing.
I just think the British do this so much better, and it's great to know that Catherine Mann's all on fire because she wants a higher rate regime.
Saw that, yeah.
You know, I'm sorry, with the UK growth today, the growth surprise in the United Kingdom, I'm sorry, the people saying, you know, United Kingdom, get your inflation in order, look like geniuses, and that includes Professor Mann.
Marvin Lowe joins us now, Senior Global Macro Strategist at State Street. Marvin, wonderful to catch up with you, sir. Let's kick off our Fed coverage. What are you expecting today? Skip, hike, pause? What is it?
Yeah, you know, unfortunately or fortunately, I think the market has it right. I think they're going to skip, you know, whether or not that's a term that they use, I guess it's up for debate. But they can't signal that they're done because the data is not there to say that they're done. So they're going to do a hawkish skip. I guess we're making up these terms as we go, which means the dots are going to increase and probably the pace of decline going into next year is going to shift a little bit.
Marvin, with all this ambiguity in what is deemed to be a snooze fest today, why is the stock market going up, up, up?
Yeah, so, you know, certainly the market is still taking the view that there's a chance the Fed could pause, that it's over with, that this credit situation is going to keep them at bay. And, you know, they ultimately feel that policy is restrictive enough. That's tonic for an equity market for sure. But I also think that the liquidity discussion, which really is kind of falling into the background, is helping risk assets at this point. Post debt ceiling, you've had a lot of liquidity enter the market as this reverse repo facility has gone down. And I think it potentially could give a false sense of security, given that liquidity has to find some place has to find a home ultimately.
You said this credit situation, and I'm struck by the fact that the Fed still seems concerned about the lingering issues in the banking system, whereas markets have moved on. Is that what's going on, that markets are basically counting out both further Fed rate hikes of any meaning, as well as a banking crisis? Well, the Fed is still looking to a credit crisis that hasn't yet materialized and that markets don't really see right now.
Yeah, for sure. You know, certainly the dynamics around concern with the banking system remain out there. They're a little bit in the background, but certainly the worst case around systemic risk is past. But the Fed continues to be concerned that we're going to get significant credit tightening because of this deposit situation that exists between banks and money market funds, and how reverse repo fits into that discussion.
Right now, as we shift forward, how are they going to signal their desire to see unemployment rates actually go up materially? That really right now they need to see the pain in the labor market much more than it's either forecast or has evidence that we've seen in practice.
Yeah, I mean, it's higher for longer ultimately. I think they're going to try to signal that they're really not thinking about the next stage of this, which is the reduction process. They'll probably try to do as much signaling as they can within the dots. But also raising the unemployment expectations, or actually I should say lowering the unemployment expectations going into next year will also say that, you know, work is not done yet.
I look, Marvin, at the dual mandate of the Fed, and I think we're in a comfortable place where we can say they've screwed up both mandates, inflation dynamics and, the challenges of inflation guesstimates. And they've really screwed up the idea the job market's going to soften and all that. We all understand that. Are they ever more ex post on this June 14th than they've ever been before?
Yeah, certainly the credibility aspect of ultimately their forecasting. And you were talking about just how many opinions are out there in the market. I think the same amount of opinions are out there with the Fed. I really think that they're just going through this week by week, hoping the data kind of moves in their direction. There are signs that it might, but those bigger numbers remain a challenge for sure.
But we had a stasis, Mike McKee says we had a stasis inflation report yesterday. Whatever. As far as I'm concerned, they're just waiting on data, including the inflation report, roughly July 12th, whenever it comes out. I mean, to me, it's just they're wildly data dependent, and that's all there is to it. Do you agree with that?
Yes, and they do not seem to really have a good handle on how to approach policy given their uncertainty with this data. So, their forecasting ability is certainly taking a hit. So they'll put out the SEP, they'll say that things are not done, and the market will continue along the path that they are done because they're really not signaling what the response mechanism is supposed to be at the FOMC.
Marvin, do you think Chairman Powell would welcome some dissent with that in mind?
No, I don't think so. I think that they're trying to send this message that they're on top of things, that inflation is going to move in the right direction. And they'll probably, I think, get some dissent out of the regional board, but from the regional presidents. But as you mentioned, at the board level, they've been working hard to make sure they have a unified message.
Marvin Lowe at State Street. Marvin, thank you. If you just think about it, if they don't hike today, but they want to signal to the market, to market participants, everybody else, that they're willing to hike again, maybe some dissent from somewhere, Bramo, might be a welcome event.
I would agree with that, because right now, what credibility do they have that they actually will hike again if they don't hike now? I kind of go back to Andrew Hollenhorst's point, which is, can they really signal a hawkish skip if everyone's saying, if you really see the need for another rate hike, why don't you do it now?
Will a skip be contradicted by the adjustment they might have to make to the projections as well? Let's work through this together. So 2023, they've got the unemployment rate currently in the current forecast, end of the year at 4.5%. PCE inflation, 3.3%. And they've got Fed funds finishing the year basically where we are right now. Tom, what needs to change today?
I don't think anything's going to change today except within the press conference. I think the people are right. It's going to be as ambiguous as possible, but he may let something down. I will predict we will see more written statements to answers to questions than we've ever seen before, even more than Lagarde the last time around.
If I asked this question 12 months ago, I get the feeling I'd get a very different answer. Does Chairman Powell care about the equity market rallying? 12 months ago, without a doubt, he cared.
Loaded question.
Without a doubt, he cared. Does he care now?
Greenspan, chapter 23 of any economic book, yes, they're supposed to care about the equity markets. This mess has gone so far beyond, I don't think they care.
The problem is, how can they really make some sort of statement on artificial intelligence and the promise of some sort of technological advancement? And a lot of people, when you read even David Focus-Landau, he put out a report today where he said, yeah, we do see recession, but AI could be a game changer, let alone some of the other technological advancements. How do Fed officials weigh in on that?
But if the market's going up, not because of AI, but from other reasons, I think if we guess that AI is overrated right now, which is a safe guess, John's question is important. Does he care about the prosperity of the market for the haves? And the answer is, I think given the post-pandemic ambiguity right now, I think it's the oddest of odd Fed meetings, and we'll give you full confusing team coverage at 2 p.m.
Just to be really clear here, it's a safe bet that AI is what? What did you say AI was?
Overplayed. Overrated.
It's a safe bet if you're not riding NVIDIA and this 170% rally and you're sitting in cash, then it's a safe bet. I mean, if you've got money on the line here, Bramo, you're riding a wave, aren't you? A big one.
I think right now you can say it's a safe bet that it's overrated. Yeah, correct. If you're not in it, but if you're in it, and frankly, if you're in a business advisor, it's hard to hear the same thing from them. They're not saying the same thing.
I go back to the high-tech firm Procter & Gamble. I mean, it just happens to be PG, or I go to Colgate, whatever, just to see a market. And the fact is I got Procter & Gamble trading at a 25 multiple.
Yeah, you've mentioned
that. Makes no sense at all. I mean, I don't even know what to do with that. And we heard that from David Kostin, where he's reassessing at Goldman Sachs to a regime a lot of people don't believe in, 4,500 SPX, and he's doing it on multiple expansion. And that's the massive equity story of the first 6 months, not AI.
Let's squeeze in one more single name. We'll talk about this a little bit later on. Tesla, third time in 2 months, prices up $250 on the Model Y. That starts at $47,740.
PE multiple 75.
It's not bad, is it? Yeah. Is that a safe bet, Tom? Equities on the S&P, positive 0.1%.
This is called election interference and yet another attempt to rig and steal a presidential election. I had every right to have these documents. I will appoint a real special prosecutor to go after the most corrupt president in the history of the United States of America, Joe Biden. They're not coming after me, they're coming after you, and I just happen to be standing in their way.
Former President Donald Trump fighting back after pleading not guilty to the charges of alleged mishandling of classified documents after appearing in court in Miami yesterday. From New York City this morning, good morning if you are just tuning in. A Federal Reserve decision a little bit later on this afternoon, going into that 4-day winning streak on the S&P 500, looking to add some weight to the rally. Equity futures right now on the S&P slightly positive by 0.1%. Bond market's doing absolutely nothing, 381.34, but doing a ton of something in yesterday's session. What was that about? We blaming the UK again? Big moves in gilts off the back of the labour market data. It's interesting, if you look at the move in gilts, we're back to the quasi-quartane kind of levels at the front end of the curve, Tom.
I think the volatility, I'm glad you bring this up.
Currency's not, bond market is.
The volatility here is tangible. I mean, that's all there is to it. And completely off the radar, people, Euro-Yen at a 151 has broken out to new strong yen, weak Japan, new strong euro, I should say, weak Japan. And I don't even know what to make of that. I mean, there's just really a set of tensions here going into this meeting. I mean, things that have been expanded.
Got a lot to work through, Tom. The Federal Reserve, got to talk about that. The prospect of stimulus out of China. And maybe we get a bit of divergence in central banks. But ultimately, anyone that tried to pause, I'm thinking of the RBA, I'm thinking of the Bank of Canada, they've come back and started hiking again. The Bank of England started all of this. I remember Lisa called it the end of 2021. They came out, was it 10 or 15 basis points at a time? And I remember picking up the phone because I was on vacation. You said, John, you said the year was over. And I said, yeah, it's going to be interesting to see how far they can go. And here we are talking about the prospect of going from like nothing to close to 6, Tom.
We're at restrictive. Now, what level of restrictive is a wide open debate among our guests, but it's a lot heavier discussion both ways at restrictive than it was at some form of accommodative. I'd also go to the Bloomberg Financial Conditions Index, which I might point out is above zero. All you need to know, folks, is that's accommodative. That's not what Chairman Powell desired a year ago, 6 months ago. Jackson Hole, he desired a negative statistic on the Bloomberg Financial Conditions Index, and it's not there.
The UK, the US, Europe, if you go back 12 months, even longer, talk about the hiking cycle that's going to be in our future. Ask people how much damage would be done to labour markets. In the UK, in Europe, in the United States, you'd be way off from what's actually developed over the last year.
Let us digress and move to what we saw yesterday, and thanks to Kaylee Lyons for her coverage in Miami yesterday of these historic events in America. Somebody asked me the other day, yesterday rather, on the street, what do I look at given all of this? And I actually want to know what actual lawyers think. Whatever the politics is, I really don't care, right, left, whatever. That's not our job here. But I want to know what lawyers think. So I go to Lawfare, which is an interesting place, People by Lawyers, and they've got a beautiful, beautiful essay here on all the cross currents going on in the last 24 hours. And they distill it down to discrete crimes against 2 individuals. That's all the allegations and what we're going to see played out over months and months. And they also state in a single sentence, this is a very big deal. When it is a big deal for the nation, we turn to Leslie Vinjamuri, head of U.S. and America's program at Chatham House in London, encyclopedic on the American debate. How's this being taken in London, Leslie? I'm just absolutely fascinated. Do people care about these historic moments in Miami, or is it off the radar?
No, it is, of course. And of course, that Friday was a sensational day because there were sort of mirror image findings. But I think that everybody here is looking back at the United States with a slight feeling of dread as to what might come next. It's been, as we know, quite a historic moment for transatlantic cooperation, with the U.S. really leading on that. But that is on, a foreign policy, national security issue, and always looming in the front view and also the rear view mirror is, what will happen with Donald Trump, what will happen to the Republican Party, what's coming next in 2020.
Got some technical difficulties there with Leslie Vinjamuri right now. We're getting the feed it's ever changing there in the video and the sound as well. Let our team work on that right now, and John will pick it up. I think what Leslie Vinjamuri's skill here is to take the dynamic of the United States and actually say, well, what do they think in England? What do they think in China and that? And the only word I can come up with is just further lack of confidence in who and what the American projection should be worldwide.
Well, these are meant to be the stable institutions, aren't they? They're meant to be an example for the rest of the developing world. You mentioned China. Let's talk about emerging markets.
Yeah.
What is the EM thinking about this after the US has preached and told them everything they should and shouldn't do over the last several decades, and then it plays out in this fashion? It's really, really serious, TK, what's developed in the last 24 hours. I think we've got a decent understanding of what the president's playbook is going to be. He's still in campaign mode.
And
you saw that leaving the court. Where did he go?
Absolutely.
Cuban restaurant. They're all singing happy birthday. It's a show of force. He gets to convey to the general public how well supported and loved he is in places like Florida still.
This is critical because you're dead on. And what's so important here is this has been a proven successful message and path for a guy who increased his votes from 2016 to 2020. He's back on path. He's back on track.
Who's to say it won't be successful again in the primaries? And you can see that captured by the polls. But Lisa, as we'll discuss over the next year going into the end of 2024, it's very different winning a primary and winning a general.
And it's very different when the world has changed in that time period. And I do wonder, Tucker Carlson, who was fired from Fox, put out a Twitter post yesterday talking about really the evils of the establishment, foreign policy and beyond. And Elon Musk retweeted it, Tom. This is one of the things that I'm wondering, how does that change the dynamic for the U.S. at a potentially fraught moment internationally as well as domestically?
Well, domestically, it's the middle. What does the middle say here? What does the middle do? But to your point is we have confidence in what, remember the photograph of President Trump with the G8? He's standing there. They're sitting at a table, Angela Merkel and the others.
All leaning over him.
All leaning over. Yeah. And to me, that's the redux we're going to see here. There's no question about that. I believe we have Dr. Vinja Murray with us again from Chatham House. Leslie, it's going to be a long, drawn-out process. How should our audience interpret the weeks, the slow-motion process to come?
It is going to be long and drawn out, and it depends partly on what happens in this pretrial phase and how long and drawn out it is. And, you know, the big question in many ways is for the Republican Party, for all of those who are quietly waiting to see whether Donald Trump can stay the course through this, or whether there will be an opening moment where some people who would, I think, very much like to put their hats in the ring, and also people who would like to not put their hats in the ring, but also don't really want to endorse Trump, but don't see an alternative right now. And so I think, you know, how long?
I think we've lost Leslie again. Our apologies for the technical problems. Leslie Vinja Murray there of Chatham House, trying to weigh in on recent developments. Good friend of this programme. She'll be back soon, no doubt. TK, I think we understand how the campaign's going to shape up now from the president. That's one. But two, ultimately, there's still legal issues. It's not just theatre, is it? What we don't understand is how the legal issues are going to play out down in Miami over the next several months.
It's easy right now to have an opinion, and the mandate, clearly the heritage of Bloomberg News and, frankly, Bloomberg Surveillance, is we're really trying to not convey an opinion, an angle. And the one angle I would say is let law work out, let the process work out, is something that can be bipartisan.
That's pure. It's also unrealistic during a political cycle where there's going to be a lot of job owning and everybody has to take sides. I'm curious about the evolution of some of the opponents, the other potential Republican nominees, the evolution of their views with some sort of
Chris Christie was stunning yesterday.
Chris Christie's job right now, he's literally getting paid by fundraisers to be the attack dog on the former president.
I'm not willing
Trump.
to say that, but I am willing to say at dinner last night, I was talking to Afterthought, and that was the topic of conversation.
Oh, what did they say?
It was a former governor of, she said, has he lost weight? And I said, yes, I think he's lost weight. You know, that's where the kids go.
Political analysis.
But I said, you know, this is the kind of debate that would be engaged in
Kitchen
a normal
table
environment.
Conversations, Bramo.
Yeah, exactly.
Yeah, you know, she threw a roll at me.
Okay. Dinner at your house sounds great. Equities positive 0.1% on the S&P. Bruce Kasman of JP Morgan up next. live from New York City this morning. Welcome to the program. We are several hours away from a Chairman Powell rate decision at the Federal Reserve. 10 consecutive interest rate hikes from the committee, and they may well skip June. Here's the price action going into it. Equity futures on the S&P 500 slightly positive. 4-day winning streak on the S&P, the longest since April. The S&P 500 at the highest going all the way back to April of last year. Think about where we were the last time this Fed met. The S&P 500 closed just south of 4,100, closing yesterday approaching 4,400. Equities have been higher since the Fed last hiked. In the bond market, yields have been higher as well. The 2-year on that day, I believe it was May 3rd, closed the day at 380. Right now, 466.25. That is an 86 basis point move on the US 2-year between meetings. And that means one thing in the FX market, dollar stronger. Euro dollar just north of 110. That was the last time we met. Right now, 108.06. So what we've had basically, Lisa, over the last couple of months or so, equities up, yields higher, dollar stronger, big conversation about US exceptionalism making a comeback.
Which raises the question, is this enough to really generate the decline in inflation that the Fed would like and the decline in employment strength that people are talking needs to happen in order for inflation to materially come down? That is what I'm curious to hear about from the Fed today.
Plenty of calls this morning. This one from Bruce Kasman and JP Morgan. Here's the quote. The FOMC meeting is likely to see a divided committee decide to pause. Chair Powell, along with Vice Chairman nominee Jefferson, has suggested that the Fed should take stock of how the economy is handling the 500 basis points of rate hikes. And for that reason, Tom, I think that address from Governor Jefferson a couple of weeks back, the reason why a lot of people, regardless of the data, thought they'd take a pass at this meeting.
Well, that's certainly the consensus right now, and we'll have to see on that. We will have this afternoon Diane Swank with us to look at this minutia, and particularly her expert impact across America. We'll have Randall Krosner with us of Chicago, one of our great financial economists. Now we take a bigger, broader picture with Bruce Kasman, of Chief Economist and Head of Global Economic Research at JP Morgan. And we do this with his Columbia heritage of, in the modern day, Jeffrey Sachs, Richard Clarida, and of course the foundational efforts of Robert Mundell. Dr. Kasman, I want to cut to the chase here and talk of Jerome Powell, central banker to the world. Your focus is on continental Europe. What is the drama for Europe today in the decision-making of Jerome Powell and the Fed?
So, as you've already mentioned, it looks like the Fed is going to pause. The ECB is also meeting this week and is likely to tighten and also signal that they have more work to do. I think one of the big issues as we look at transmission here is about synchronization. There's obviously a lot of concern about a U.S. recession. We don't think the U.S. is falling into recession right now. But Europe is showing very strong divergence in performance. The service sector is doing well. The manufacturing sector is doing poorly. It has the same issues around bank credit tightening as the U.S. How the European economy plays out here is going to be a very important factor in determining both the overall global picture and certainly have some impact on the U.S. as we go through the rest of the year.
You and I, Bruce, have read Dooley, Garber, Folkerts, Landau, and all the different macroeconomics coming out of David Folkerts Landau's work. And one of his great comments is there will be fiscal stimulus in Europe that will come to the rescue of Europe. It's a different fiscal calculation than Jerome Powell has. How does that play into what Europe will do off of this meeting today?
So, I mean, the simple point here is I think there's more work to do for the ECB. Personally, I think the Fed will ultimately have more work to do here. It's taking a pause, but I don't think it's going to get inflation under control. And I think one of the things that people who are looking for an immediate recession are missing is that while monetary policy has tightened a lot, fiscal policy is moving in the other direction. That's there in Europe. The recovery fund, as well as some of the emergency measures around last year's crisis, is a factor. In the U.S., look at what's happening on defense spending. Look at what's happening in government hiring. State and local spending is high. This is a very different picture than we've seen over the last two cycles, where early in the cycle, fiscal policy in the U.S. and Western Europe tightened materially.
Bruce, this is really interesting. The idea that fiscal stimulus, on one hand, will force central bankers around the world to tighten much more than people currently expect. Is that what's going on? Do you think that people are misguided in thinking that the Fed is done pretty much around here and is going to hold rates where they are because of the fiscal impulse?
I don't want to put too much weight on the fiscal stimulus. I think it's one factor among two or three, which is promoting resiliency here. And I do think the most important factor in terms of what's going to drive more central bank tightening, if we get it, is the persistence of inflation, the underlying shift that's taken place in the inflation process, how that's playing through in a world in which we still have damage done to labor supply and tight labor markets. That's the ultimate problem. And just from the point of view of the Fed today, it's reasonable to take a pause. But what a pause is doing here, it's promoting risk appetite in financial markets, which is undermining monetary transmission. And it is, I think, signaling to the market that the Fed is gradualist on lowering inflation. And that works against the idea that there's some inflation that's becoming embedded in expectations and wage and price setting. This is the problem the Fed has today, and that's one of the reasons why they're going to signal to us that they're not done. But it's going to be hard to find that balance here.
I'm going to say something kind of sacrilegious. Let's say it's actually worse for risk markets right now if the Fed doesn't hike further and keeps rates where they are for a very long time. Isn't that worse than potentially breaking something and then having to come in with rate cuts and sort of doing a full reversal, this sort of slow bleed, this sort of boiling of the frog that a lot of people are anticipating?
Ultimately, it might be. But right now, I think if there's anything we should appreciate as economists and more generally, is that it's very difficult to actually forecast exactly where we're going to be in 6 to 9 months. There is a risk the economy is going to slide into recession. The fact that the Fed is pausing, the fact that the Fed is telling us it's going to be gradualist on inflation in terms of bringing it down is a constructive signal that promotes resiliency. I think there is, on my mind, a likely scenario where inflation doesn't come all the way down and the Fed has to come back. But there is still some possibility that we have a soft landing. So I think for the near term, it is certainly a reasonable thing for the Fed to do, and it is certainly going to promote resilience in the economy. I do think more likely than not, it's not going to prove successful. And I think, as you say, we're going to pay a price for that.
When you talk about the potential for inflation to come back or not come down all the way to where they'd like, is that driven by wages and some sort of wage price spiral that people are underappreciating?
I think it's a bit of a mistake to put it on tight labor markets, to focus particularly on what we call a Phillips curve relationship. I think what you've had happen here is two things. One is we've damaged supply in a way that it's not fully recovering, and particularly in the U.S. and Western Europe, it's about labor markets in that regard. But I think the bigger issue here right now is that we've started to embed psychology in which wage and price gains are linked, which wasn't the case over the last 30 years. And I think in order to bring down inflation, you need to compress pricing power on the corporate sector side. Unfortunately, when you do that, that does hit labor markets. But it's a pricing power story. It's changing the behavior of businesses, removing that price pressure that's coming through the system, which is a break from what we've seen over the last 3 decades.
Bruce, it's J.P. Morgan's fault. I'm going to go to Richard Clarida, the former vice chair, and of course all his work at Columbia. And in an essay in The Economist, I'm going to say a month and a half ago, he really made a case that we're not going back to 2%, that this is a Fed that has to find 2.x%, whatever the number's going to be. Your Michael Ferroli changed the debate single-handedly. We're going to blame Ferroli by coming up with a potential GDP statistic that was well under 2% as well. Yeah. Do we have to adjust that now after all of this imputed inflation into the system, what the Biden stimulus has wrought? Do you have to adjust the Ferroli potential GDP up, which makes it more comfortable to get to a Clarida statistic?
So we've been running with a potential growth rate for the U.S. of about 1.5, really, as you're mentioning, for almost a decade now. And I think you're raising a very important point, which is there's a lot of stuff going on here that could have an influence on potential growth going forward, and specifically productivity growth, which is a key to the inflation outlook. I'm agnostic here. There's a lot of cross currents. I haven't seen anything that convinces me we're either materially raising or materially depressing a potential growth. I think we've done damage to supply in that we now have probably 2.5 percentage points less of people in the workforce than we had on the pre-pandemic path we were on. That's the immediate problem, and how that is interacting with underlying inflation psychology. If we get better potential, that'll help us. If we get worse, that'll make the trade-off worse. I'm agnostic on how that's going to play out, at least at this moment.
I look, Bruce, let's bring it back to the festivities today at 2 p.m. I hate the skip and the pause chat. John busts my chops on it nonstop. Bruce Kasman, are we just debating an asymmetric or symmetric outcome here? I'm clearly in the camp that it can be an asymmetric decision. Are you?
Well, first of all, it's a divided decision. Keep in mind that probably close to half of this committee would vote for a rate hike. So it's going to be a pretty contentious debate. I also think it's hard to talk about a skip. It's possible, but it's not our view. I think the Fed has 6 weeks to the next meeting. If it is actually trying to take stock of what actually is happening in terms of banking sector stress, monetary transmission, it's going to take more time to see that. But at the same time, I think they have to tell us that they have not declared victory on getting inflation down, that there is pressure for them to move more, and that the likely scenario, and I think it'll be in the statement, it'll be in the dots where we'll see an extra rate hike being pushed in, and it'll certainly be in more detail and more color in Powell's press conference, that they're more likely than not to continue raising rates sometime later this year.
Bruce, do you think they'll care that equities are rallying?
I don't think the Fed's very sensitive to equities rallying, but I do think the broader picture here is that financial markets are showing very little stress. They've improved. Risk appetite has increased. Credit conditions have improved in the last 2 or 3 months. And there's a significant offset to the tightening that's going on in bank credit. And I think that does matter to the Fed. And they're trying to manage that in a way that they don't unleash unwanted exuberance here that they're going to have to deal with later on down the road.
Interesting. Bruce, wonderful to get your perspective. Looking for a divided pause.
Awesome.
A little bit later on this afternoon. Bruce Kasman of JP Morgan. TK, I know you hate the language, but it's the Fed's language at the moment. They're going around, they're allergic to the word pause because they believe that if they say pause, this market price is in cuts. They hear pause, this market hears
folks.
The cycle's over, and they don't want to communicate that.
That conversation with, I literally want to call him Professor Kasman, with Dr. Kasman, was so rich about the broader theoretical picture of what we have wrought out of this pandemic. And I think a great divide between me and you two, I'm with McKee. I give these people great discretion.
I don't know how McKee feels
given
about that.
Dealing, no, I give them great cover with dealing with a medical event. But you know what? Is the medical event over? I mean, that's the raging debate here. Are they working within conventional monetary analysis, or are we still in pandemic land?
I don't think we're in pandemic land in quite the same way. And Tom, what pandemic land meant in early 2020 is not what pandemic land meant in 2021, in 2022.
Yes.
That's what they missed. The kitchen sink did at the early part of the pandemic, living in pandemic land, your phrase. And they did what they had to do. Coming out the other side after round of fiscal stimulus and support packages that came from Washington, from President Trump and then from President Biden, with a much larger package in early 2021. TK, pandemic land changed. And this chairman missed it.
And part of this, we haven't even discussed this.
They were doing QE, Tom, right the way through 2021 into early 22.
Where we are today, Lisa, and it's a double barrel. We're looking at Apple as a $3 trillion company. And on the other side, I'm seeing a lot of articles in the land of Marty Fritzen about junk debt all of a sudden starting to blow up. I mean, the barbell here of prosperity at Apple versus the challenges in the Bramo space is something.
Although the problems in the Bramo space are getting resolved pretty quickly. If you take a look at spreads, for example, in high-yield bonds, they're the narrowest, they're the lowest going back to March.
Why?
They have rallied because people see this dynamism continuing. I want to pick up on something Bruce Kasman said. The Fed doesn't want to unleash unwarranted exuberance. The fear of unleashing exuberance after raising rates by 500 basis points suggests something pretty profound about an economy that just is not diminishing to the degree that anyone thought. And to me, that is the key question. Why? Is it just lag effects, or is there something new in the post-pandemic reality with a tightness of a labor market and the shifting winds of a strong economy?
Do they accept a higher inflation rate? You mentioned Rich Clarida. Is that the direction of travel? Jim Caron, Morgan Stanley, talking about the same thing yesterday.
Yeah, and what's so important there, 2% is not the old view. It was a sub 2%. So it's a long way to a Clarida level.
Equities this morning positive 0.2% on the S&P 500. And read a set of energy aspects up next.
I have been consistently in the camp that we would see some slowing in growth, but no recession, and that we could see inflation come down. And part of that is because I've had confidence in the Fed that they would be paying careful attention to the data. We don't know how long it takes for monetary policy changes to actually affect the economy. And I think that they have already done so much.
Abby Joseph Coven there of Columbia University, and previously, of course, for a long time, of Goldman Sachs. From New York City, Fed decision day, equities up by 0.2%, four-day winning streak on the S&P 500, coming into Fed day on the longest winning streak going back to April, and at the highest levels since April of last year. And even when you account for all the hikes we've seen, the banking failures through March, which we continue to rally through, this equity market is now positive, point to point, from the start of this hiking cycle, Tom. Going into today's
It's a great equity market. People are going to go, what did Abby Joseph Cohen say? Well, she didn't predict a bull market, but she clearly stated, John, she's in the camp of rotation to more valued, away from tech towards those that really haven't moved. She's not doing an analyst thing. Was that hilarious at the end where she was jamming on David Kostin?
Did she give a price target? I thought she did.
She got a price target, and she's like, well, I read Kostin. I'm paraphrasing. I read Kostin last night, but, it was very funny.
Are we tracking price targets out of Columbia now?
We are. I think she's got a Bloomberg at her desk.
She's actually advising a lot of public pensions and such, and it's a very interesting moment. She said that really the time to get into equities was last year, and now it's really more in fixed income.
Doesn't that really frustrate you? It drives me nuts.
I know. It's like you missed it. Forget it.
It's always the way. Everyone's like, the easy money was made. I mean, stop it.
But that's the first leg.
I hate that phrase.
You're right. You're 100% right.
No one ever comes on TV and says, next 12 months, make the easy money. Like, it never happens. Next 12 months, make the easy money.
The question is, how do you have a second?
It's made.
How do you, if you believe in a Akampora Yardeni October low, what's the second leg of this bull market look like? And that was the question to Ms. Joseph Cohen. And the answer is she looks for rotation.
Well, the pain trade would be a rotation trade.
Yeah.
A lot of people have missed out on this rally. They've missed out on this move. They're sitting in cash. I'll catch up with Bob Michael at JP Morgan Asset Management. We'll do that at about 9 a.m. Eastern time. Look out for that conversation because he thinks it's a real risk you get trapped in cash. And that's been a conversation on this show now for a number of weeks.
About 4 days ago, I said to somebody, can we just get Amrita Sen on? Get in her date calendar. Let's go. Co-founder, director of research in energy aspects on oil, on hydrocarbons, on the shock of $66 print on West Texas Intermediate. Amrita Sen, what is your confidence that demand will weaken in oil?
I think I have very little confidence of that, Tom, simply because the data continues to come in stronger than expected. Now, we've been conservative on demand, that's fine, but I absolutely don't buy into this argument that, China's not reopening, the data is coming in up 3 million barrels per day year on year. Sure, the base is weak, but even otherwise, India is printing record high growth. U.S. demand, particularly on the consumers, is still holding up. There's a huge disconnect between the data that's been coming in and forecasts versus prices. And it's really hard to square right now. I just don't think I've seen a market like this before.
I agree, and that's certainly the zeitgeist among everyone that plays the petroleum game. Is your scope here for Brent crude to move X number of dollars up per barrel, $5, $8, $10, or does Amrita Sen look for a jump condition on the path back up to 120 a barrel?
I think there needs to be a very clear kind of jump condition. There needs to be a catalyst. I think right now the problem is we just aren't getting the signals from prices that, things are tight, even after Saudi Arabia made those unilateral cuts. Part of it, I genuinely believe, Tom, if you ask me, what did I miss this year? It's been the rising cost of capital and what's that doing to the market, which is destocking. Nobody wants to hold inventory, and I think we are, as a world, going towards lower inventory forward cover. And I think that's probably one of the big reasons oil isn't rallying, because everybody's just dumping inventory. Once we are through that, that does lead us more susceptible to price spikes from any supply losses. But we need to see very clear evidence of stock draws, because so far, yes, stocks are drawing, but I guess it needs to be maybe in the visible centers like the US, and we've had so many refinery outages, that's creating a problem as well.
This is what Jeff Curry was talking about as well, the inability or unwillingness to pay to actually store oil right now, and that people just don't want the physicality of it in part, and as well as some other issues. And yet the International Energy Agency came out overnight and said that demand is diminishing greatly, in large part because of renewable energy and renewable and electric vehicles. Do you think that's overstated, that we could see peak oil demand in the next couple of years?
And yet they revised demand up for this year. Did you see that? I think there's always going to be this dichotomy with the IEA, that they keep pushing the narrative of peak demand, and yet they keep pushing back the year, or they keep raising the level at which demand is peaking. Pretty much the last few years, they've managed to underestimate demand considerably. And I think, look, from a government point of view or a policy point of view, yes, the narrative has to be that there is going to be peak demand because we're trying to transition away from fossil fuels. But the reality is very, very different, particularly in emerging market. Yes, China, for instance, we do think gasoline peaks this year, but that doesn't mean it falls off a cliff. And the biggest driver still remains trucking, and it's really diesel demand.
So what's sort of the distinction between the people who think that renewable energy sources are making a material impact on demand, rendering oil a sort of insufficient view or lens on global demand, and those who say, stop it, it's not true, you're actually seeing lots of diesel demand and lots of gasoline usage?
I don't think, it's not that black and white, right? I don't think that renewables isn't making an impact. Of course it is, but it is theoretically how much more could oil demand have grown by? It's not that we are not seeing record high demand in places like whether it be Latin America or India or even China. I guess the question is, without renewables, could oil have grown further? Yes, absolutely, it could have, but that's confusing matters, right? This year, IEA's report today as well says oil demand's going to reach a record high. Are we investing enough to meet that demand? No, we're not. And I think that's where the crux of the matter comes through.
Amrita, thank you for your perspective. Amrita Sen there of Energy Aspects on a very interesting oil market right now, and an unhappy Riyadh, an OPEC Plus who does not want to see prices down here at 75, Tom, on Brent.
Absolutely not. And Lisa nailed it here with the linkage here between what Amrita said and Jeff Curry of Goldman Sachs. I thought Jeff, the microeconomist from Chicago, was just brilliant here on, wow, has the world changed for Riyadh, for Houston, and for everywhere else in the oil world with the interest rate structure in here. I mean, it is a sea change for someone as acute as Amrita Sen.
Big change for the SPR as well in the last 18 months.
I don't understand. Where are we on that?
I saw a story the other day that said they're going to look to refill it by 12 million barrels this year. This year, Bramo, after draining it by what? More than 100 million.
I mean, basically, a pitbull on
big effort.
I'm lost in this. Isn't it just a simple analysis? Wait. Oil is printed $66 the other day.
Yeah.
West Texas is 70. Doesn't somebody just go fill the SPR? Isn't it that simple?
I thought that was what was happening.
Well,
no?
Not so much. And how much is it just because they don't have the money right now, especially with some of the debt ceiling constraints and some of the money
Use
that's
your
getting
Shell
funneled to other
gas
places.
card. You get frequent
Or
flyer
they're just
miles
happy with
it.
where prices are. They're just happy with where prices are.
I know, but the reason for the Strategic Petroleum Reserve is they have it when we get an Amrita Sen 120 a barrel.
Yeah, that was the reason for it. And you weren't meant to drain it in the way it was drained either. In the last 12 months, which is why some people called it the midterm reserve. Do you remember that? The strategic midterm reserve?
I do wonder, at the same time, to your point about prices remaining low and how they like this, at some point, when do they start to get annoyed that the price of gasoline hasn't come in quite as much as the price of crude? And this is something that we keep seeing.
Yeah, I think we see that. It's down 23%.
The oil majors start to increase their push toward fossil fuels and away from some of the renewables that we've been seeing.
Gouging, Bramo. That's what it's about.
Well,
greed.
I'm not saying that they're gouging. I'm just saying I wonder when they're going to start talking about that again.
I still, with taxes, and John, you've lived this. I looked up yesterday, in the United Kingdom, a gallon of gas is $5.40.
I think it's,
and here it's $3.50. I can't remember the compare.
I think close to $1.50 a litre sterling.
I don't do that. I can't do that, John. It's like Fenning and farthing.
It's expensive.
Shilling.
Well, we're not using penny farthings
Did you do
anymore.
shillings?
I didn't do shillings. I wasn't around for shillings.
God, I read Dickens and I just don't even know what they're saying.
Far too young for shillings, Tom.
Yeah, you read Dickens and you're like, how the hell do they keep track of this stuff?
Well, clearly they changed things so that you could keep track of things, Tom. Yeah, you seem like a man that would have lived with shillings. Would have enjoyed it too.
I tried.
Tossing people shillings, walking along. Would you have had a cane?
Yeah.
Would have.
You get the cane with a little knife in it in case the bad guys go after
a little knife at the end of the
cane. Yeah, that's like,
From like Mary Poppins
we
to
should
James
do.
Bond.
Oh, it's Sherlock. I read all the Sherlock Holmes.
You would have made a great Scrooge. Never mind Michael Caine. Can you imagine? That would have been a great remake. If they'd given you the job instead of Michael Caine, that would have worked. Equity futures. It's almost there. Humbug. Up 0.17%. It's Fed decision day. Up next, someone who called this market rally in early April, looking for a breakout. That's what we got. It's Anastasia Amoroso of iCapital.
We think we're sitting towards the top end of a very strong rally.
The Fed has made significant inroads in the battle against inflation.
What's left behind is a lingering higher inflation rate than we would like.
I think that the Fed isn't done, and I still don't think it's going to cut rates quickly.
If I were a voting member of the FOMC, I would vote for wait and watch.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
That vote is just around the corner, live from New York City this morning. Good morning for our audience worldwide. This is Bloomberg Surveillance on TV and radio alongside Tom Keene and Lisa Abramowicz. I'm Jonathan Ferro. Your equity market on quite a run year to date and since this Fed started hiking. On the equity market right now, equity futures up by 0.2% on the S&P 500. TK, we talked about this in the last hour. I think we need to do it again. When the Fed started hiking, the S&P 500 closed at the level, Tom, a level below where we are right now. This equity market is positive through the hiking cycle. It's positive through banking failures. We've had a bear market. And for many people, we're back in a bull.
I mean, you're better at the dots than I am. I don't believe in the dots, but the basic idea is the great miscall of the last 6 months is recession. Matt Luzetti of Deutsche Bank absolutely nailed it. He had the courage to put a date on it, and his date was way out. We're not even yet to the Luzetti mark. And the answer, a lot of other people were sooner, and maybe including many Fed members, and the answer is the recession hasn't happened. Stock's up.
It's a three-part act today. We've talked about that a few times. You'll get the statement, the projections, the presser. Let's talk about number two, the projections. There is a belief. A lot of people believe this, that today you're going to have to upgrade GDP, downgrade unemployment, and maybe just give a little nudge to that dot plot a little bit higher to imply that we can go again.
Because the reality is they're not going to want to signal that everything is fine and that a soft landing is the best base case and Tom is falling asleep or something. He's grunting. But I will say there is this concern that we have going forward about where they see the potential, the sort of asymmetric risks of inflation restarting later versus having already done enough.
What is the efficacy of the dots? What is the value add of the dots other than know what Bullard thinks?
Signal. End of story. Today, if you want to demonstrate today that the pause doesn't mean you're done, then you need to have something baked into the median dot. And I think that's why, to some extent, I mean, this is a guess, I would imagine that Chairman Powell might welcome some dissent today. If you want to pause and communicate to the market that we're not done, then it would be nice if some people on the committee put their hand up and said, I don't think we're done. I think we need to do some more.
It creates the uncertainty that they would welcome that potentially could tamp down on unwanted exuberance, as Bruce Kasman said. I am wondering, though, again, their credibility. They can move these dots around like they can move anything around. It's not like they're, committed to the dots. It's not like it's actually fantastic kind of messaging. So, this is the real problem that they have on their hands. When they signal, when people talk about more work to do, is it in holding rates or is it in having rates materially higher? It's unclear.
I think we've all said on the record that if the Fed had a choice, they would have got rid of this dot plot a long time ago. It's kind of been quite confusing at times, and maybe today is one of those days. But ultimately, the belief is today, consensus view, no hike, but communicate you're not done. You're going to look at the data as it comes in. Some people do think we will get a hike today. Let's be clear about that. I know the consensus view on the street.
Is Hollenhorst still there?
Hollenhorst is still there over at Citi. He still believes that inflation is still stubbornly stable. I think that's the word he used. Interesting term that in his note yesterday.
With great respect, I'm just suggesting the monetary and financial mathematics, which Governor Krosner is expert at, is secondary to an analysis of domestic final sales versus international import inventory dynamics, say, off of a weakening China. Does a weakening China have more to do with where this Fed is going than the dots? I just think we got to get back to basics here, which is everyone, including me, has been wrong about a buoyant, resilient American GDP.
Big time. Yeah.
Big time.
Everybody we've spoken to. Couldn't agree more. Equities right now on the S&P 500, just about positive. We're up by 0.2%. The stage is set as follows. The scores look like this. Yields up about a basis point here, Lisa. The 10-year, 3.82.
Let's get the times of some of the key moments of the day. 8:30 a.m. We didn't even talk about this. We get PPI, the latest read after yesterday's CPI. This is more manufacturing input prices that have come down much more sharply than what we've seen over in services and beyond. just curious to see how much this gives a tailwind to some of the earnings, perversely, in the S&P if the input prices are coming down. 2 p.m. is the FOMC rate decision. Fed Chair Jay Powell will take the helm at the news conference at 2:30, and we do have our Fed special starting at 1:30 p.m. Eastern time. We have Randy Krosner, former Fed Governor, Matt Lazzetti of Deutsche Bank, Michael Collins of PGIM, and Seth Carpenter of Morgan Stanley, among many others, John, to kind of parse through what a hawkish skip might mean.
Great lineup. Looking forward to it. With us around the table, Anastasia Amoroso, Chief Investment Strategist over at iCapital. Anastasia, good to see you.
Good to see you.
I remember you sitting around this table with Tom and I maybe several months ago. I think early April. I think it was Good Friday, Payrolls Friday.
Good memory.
And you made the call that we would break out to the upside on the S&P 500. You forget everything. Had a really tight trading range up until that point. We've broken out. Everyone's on board with that move now, seemingly, or at least slowly they're capitulating. Where are you now? Do you have this view that we broaden out, or do you want to de-risk and take some of those profits?
I do think we're broad now, John, and I think we have been doing that for the last couple of weeks. And, you know, the reason for that, as Tom, you were just talking about, is this U.S. economy has been so much more resilient than anybody has expected. And so as a result, we've gone through the earnings downgrade cycle. And if you look at the earnings revision ratio, it is actually now positive for the last few weeks or for the last month or so. And so that instills a lot more confidence in the EPS part of this equation. And then, you know, at the same time, the Fed, whether it's a skip, whether it's a pause, the reality is they're not going to go 75 basis points for consecutive more meetings. So we're done with that. So we can have some stability in valuations as well. So that's why I think this rally does broaden out.
The simple question is Apple under-owned? But far more than that, is it your take that the institutional money, typical fundamental buy hold for 3-year money, has missed this market move and there's a general statement under-owned?
Massively under-owned, Tom, and a lot of investors found themselves in chasing mode. And first, it's kind of the high-velocity money, the systematic traders, the hedge funds, and guess what? They all piled into this market, and that's what propped it up higher. But then you look at the bond and cash flows and what they have done versus the equity outflows. There's a massive amount of capital that could potentially pivot here. And I think this capital is going to be looking at valuations and saying, well, technology has had its run. By the way, I still want to be a tech investor, just want to be a little bit prudent about taking some tactical trades off. But the money is going to look at valuations and say X technology, the multiple on the S&P is actually in line with its 10-year average. So that's why, John, I also think this rotation can broaden out. And I also want to bring China into the equation as well, because as pessimistic as everyone is on China, the great news there is China's CPI inflation is 0. You know, policy rates are higher. There's room to cut rates. There's room to stimulate in China. And the last few weeks, we've really seen the willingness of the policymakers to step up the stimulus, at least for now talk, but I think measures as well.
Given that backdrop, if the Fed does have a skip, hawkish, whatever you want to call it, will that unleash unwarranted exuberance in risk assets in the U.S.?
I mean, it already has, right? We sort of pre-traded the pause, the skip. And, you know, I think this exuberance is somewhat warranted. And by the way, if you go back in history and if you look at rate hikes, you know, the Fed hikes rates, but it doesn't cause an imminent recession. There's typically a period of time before the recession onsets. And there is this exuberance phase. I think some call it euphoria, where the market rallies for the 12 months after the Fed actually ends its hiking cycle. But the reason it rallies, Lisa, the reason I say it's warranted is because the economy is still hanging in there and the earnings still hang in there. So I think this exuberance might be justified.
What's the tipping point? Let's say the Fed does hold rates here for a long period of time. When does the tipping point come? When perhaps the pain starts to get felt, when perhaps this exuberance starts to wear out?
I think the Fed would need to go higher and potentially much higher to really crack this economy. And, you know, I say that because if you look at this economy with 5% rates, yes, we're feeling strains here and there, and there's pockets of dislocation that are to come. But by and large, this economy is doing just fine with 5% rates. So I think you need to raise rates to a much more restrictive level for something to really crack that would cause the crack in the unemployment rate.
Within your macro view, does a 60-40 allocation work? I can't make the math work in my head. Are you a 60-40 type, or do you have to go to a different mix?
Well, this year, anybody who's declared 60-40 to be dead obviously has been wrong. 60-40 is one of the top performing things out there.
Off of a miserable year, granted.
Yeah, exactly. But if you look, Tom, over the last 3-year, 5-year, 10-year, 15-year period. And if we expand beyond the 60-40, and if I broaden that out to private market strategies like growth equity, like venture capital, like private equity buyout, like private credit, all of those things have actually outperformed the 60-40. So we want to look beyond the 60-40, and it's not just something that worked last year. I think that's something that works for the next several years.
Just to build on something you said about the labour market and how far Fed funds would need to go, where does that leave the bond market? Never mind equities, let's put stocks to one side. Where does that leave fixed income, treasuries? What does a 10-year look like over the next 12 months?
Yeah, I mean, I think the 10-year is supported around these current levels because, if the Fed needs to go much higher, the front end of the curve rises, but the back end really doesn't because it's a function of the forward growth expectations. But if the Fed continues to hike rates, that means the recession probabilities likely rise. So I actually think the 10-year offers, decent value around these current levels. And also, if we are wanting to prepare for a 2024 recession, that's what you buy. You buy the 10-year, you buy the 30-year, and I think that's a great balance to maybe some of the cyclical stuff in your portfolio.
You think we're at that point now to make that move currently?
I think you can. I don't think you have to imminently hedge a recession, but I think if you're buying some 10-year treasuries into your portfolio, I think they can provide some stable value because, again, the growth expectations are not likely to spike materially higher. Inflation expectations are not likely to move materially higher. So I think that's going to keep the 10-year anchored.
Anastasia, awesome call on the equity market for the year so far. Thank you. Anastasia Amoroso there.
I didn't listen to her.
You should do, TK.
Triple
it's usually
all cash.
the polite thing to do is to listen to your guests.
I
triple
just
lever
didn't believe her.
QQQs.
Yeah,
I didn't believe her.
That's better. Are you in cash now, Tom? You coming out of cash?
No, we're there, and the gross up has been so great with that 5% coupon that we're slotting in a 16% gross yield. And you take the 2 and 20 off of it, and then it net clean to the clients. It's really worked out.
2 and 20 on cash.
Yeah,
it's quite a business you're running there.
Thank you. Net clean to clients. We've got a new ETF coming out that'll be great.
Oh, we can't wait for that, TK. Yeah. Looking forward to that. Coming up on Surveillance, Mike Schumacher of Wells Fargo. We'll talk about the bond market with him. Look out for that. Elisa, the Federal Reserve just around the corner, a height, skip and a pause, and I think everyone's sick to death of this conversation, aren't they?
Yeah, although it's changing a little bit. Anastasia was really talking about that. Much more restrictive. What does that look like? Do they start gaming out their understanding of why this economy has remained so resilient?
It's going to be interesting today. 2 o'clock, you know what we're going to be running?
What's that?
Bramo dissents.
Lisa dissents?
That's going to be
Bramo dissents all the time. Bramo dissents all the time. In fact, I think a lot of people would prefer Bramo was on the committee so someone could actually dissent at the Federal Reserve. If you are just tuning in, welcome to the programme and good morning to you. Live from New York City. Your equity market up 0.2%. Coming up on Bloomberg Surveillance, Mike Schumacher of Wells Fargo, David Balin of Citi Global Wealth, Mike Wilson of Morgan Stanley. Mike Wilson, a conversation you do not want to miss. We're going to take place, that conversation, about 8:15 Eastern Time. This is what Mike had to say coming into this week. The S&P 500 has crossed the 20% threshold. More are declaring the bear market officially over. We respectfully disagree due to our 2023 earnings forecast. His call on the earnings is something that he's stuck with for the whole of this year. When does that more pronounced weakness, Tom, start to come through? We talked about when earnings season begins, July 14th. JP Morgan.
Everybody has a belief construct in that. And what's interesting to me is to start at the top of the income statement. Earnings are defined down any number of levels, EBITDA, operating income, even gross margin up higher. Forget about it. Go to revenues at the top. And if you get a persistent inflation, by definition, you get a better nominal GDP, which means, and I use Honeywell as a proxy, instead of a surprise 8% revenue, you don't go back, Lisa, to 4 or 5%, but you get 6.8% revenue, and that's the beginning of a better earning structure.
Although I wonder if it's a tale of two different types of companies, because smaller companies are seeing a bit more pressure.
Oh, yeah.
So how much does that really highlight some of the weakness that we could see?
Live from New York, the conversation will continue, counting you down to Chairman Powell on a Federal Reserve decision, looking for a skip, a pause, call it whatever you want. Just don't call it the end of the cycle, apparently, if you work at the Federal Reserve. From New York, this is Bloomberg.
This is called election interference in yet another attempt to rig and steal a presidential election. I had every right to have these documents. I will appoint a real special prosecutor to go after the most corrupt president in the history of the United States of America, Joe Biden. They're not coming after me, they're coming after you, and I just happen to be standing in their way.
The president on the campaign trail, the former President Donald Trump, fighting back after pleading not guilty to the charges of alleged mishandling of classified documents after appearing in court in Miami yesterday. This morning, today, good morning to you, counting down to a Federal Reserve decision just around the corner later on this afternoon. Consensus view is no change, a skip, a pause, but ultimately a Federal Reserve that is unwilling to communicate the end of the hiking cycle. That's what many people expect. Going into that, your equity market positive by 0.1% on the S&P 500. Set up as follows in the bond market, yields just about unchanged. The 10-year at 381.73. And in the FX market, slightly weaker dollar, stronger euro, 108.08. TK, the move in crude, $70.31, positive by 1%.
Great conversation with Amrita Sen there. I was find really a high point so far in our hydrocarbon discussion is her agreement with Jeff Curry here over the interest rate structure. And that interest rate structure affects everything, including what we're going to see at 2 p.m. this afternoon.
Torsten Slok just published over at Apollo. More demand destruction needed to get inflation to 2%.
Yeah, okay.
How much demand destruction will we see between now and July? To Bruce Kasman's point over at JP Morgan, it's a very short window between now and the July meeting. There's not a ton of information this Fed's going to get to make a decision as to whether they need to go 25
Expanded.
or not.
All of a sudden, it's a short window to the end of the year, quite frankly, as well. And to the Slok note, demand destruction, the issue is on the supply side, we still have massive pandemic dynamics that they're going to struggle with today.
I'll read you the note, Tom. The stock market thinks we have the worst behind us, which shows that earnings growth is expected to bottom this quarter and then improve quite rapidly over the coming 4 quarters. This forecast will only be correct if core inflation moves quickly down towards 2%. If core inflation remains around 5%, then the Fed will have to put additional downward pressure on demand in the economy and ultimately earnings. That right there's the tug of war right now. Pick your battle. Pick your side.
Right. Well, we're going to see that. We'll see it today at 2 p.m. We've got a wonderful set of guests lined up. Thrilled to have Diane Swank joining us a bit later. Right now, on the festivities of yesterday from Miami to New Jersey, Amory Horton joins us, our Bloomberg appearance in federal court correspondent today. Amory, I'm going to go back with the language that we saw yesterday. I'm going to really try to make this apolitical. To a wonderful Philip Bump exercise in September in the Washington Post with lots of pie charts as he tried to figure out with his team at the Post, how big is MAGA out there? I mean, we got a massive dose of it yesterday, obviously. What are the centrist Republicans doing? Because the Philip Bump pie charts say that MAGA's really not that big as a general statement. What's the response to the non-MAGA conservatives in this nation?
Well, I think they're trying to figure out how they could potentially coalesce around another candidate. The issue, of course, is the concern for many of these centrists is that what you could see is what we had in 2016, which is a plurality, which is that even if MAGA is not that big, as you're talking about this pie chart, the issue is there's too many candidates sharing the remainder 70%, and the former president still has that grip on 30% of the party. Again, it is very early in this election cycle. There is more than 500 days until November. Potentially, there's rumors of other individuals getting in, the likes of the governor of Virginia, Glenn Youngkin, when their legislature elections are up more towards the fall. So this is what the centrists are talking about, and potentially the issue they see is that maybe the former president will have too many legal hurdles and he'll just start drowning in them. Of course, the flip side of that is that the former president used yesterday this massive legal hurdle. The first ever former or current president to be arrested in federal court. He used it as a campaign rally. What was shown after is that he made a stop at basically the Ben Chili Bowls of Miami, going to this Cuban restaurant where they were singing happy birthday, and it became an all-out campaign event. And this is where the former president really thrives.
His message, and it's always been his message way before 2016, is a message of grievance. Clearly, we all heard that yesterday, those that support the former president, those that do not. How is his message of grievance playing across the Republican spectrum right now?
Well, when you look at what the other nominees are saying, I would say that you're starting to hear a lot more noise about, as they thread this very fine line of making sure they do not ostracize these the base and the Trump voters. You are seeing a lot more of these, quote, serious concerns of this indictment. It's a serious case. You also had a new line from Nikki Haley, his former UN ambassador, when she served under Trump. Not only has she said this was reckless, she's now come out and said she would pardon the former president if she became president or the candidate and then president, because she thinks it would be good for the country. You have Vivek Ramaswamy, who also is a candidate. He's talking about and already said he would pardon the former president, but saying all need to make that case. Potentially, this is one way some see they could push Trump out of the race, but that will be the next and I think big litmus test over the coming months.
And Maria, I'm sure we'll cover this extensively over the weeks and months to come as it does evolve. I do want to just quickly get your take on something we were talking about a bit earlier in the program about the SPR and why we aren't refilling it at these rates. And sorry to throw you a curveball, but it's something we've been talking a lot about. We're at that $70 level. Why are we not hearing about material refilling of the Strategic Petroleum Reserve?
Well, I think at the moment they're still in the final legs of the drawdown. You cannot draw down and fill up at the same exact time. It's also a great question because the administration has said, though, around these levels they would. Potentially they see a little bit, or they could. I mean, I'm looking in a crystal ball here. Maybe they do see further weakness in the oil price and would prefer to wait if they drop maybe potentially closer to $60 a barrel.
Or they're just happy where prices are, AMH, and don't really care about refilling the SPR.
They could be. They could be happy where prices are right now and don't want to have this hurdle of spending some more money. But potentially they also could see some more weakness. I mean, what was pretty astonishing is after that last OPEC meeting where you had another unilateral cut from the kingdom, prices barely didn't even break $80 a barrel on Brent when you looked at the close of day. So that speaks to me potentially some more concern in demand. And obviously, when you look at demand, you have to look at China.
Brent right now, 75. AMH, thank you. Anne-Marie on the latest in Washington. Thanks to Lisa for bringing up the crude market as well. Just to recap some of the forecasts out there from JP Morgan. Cutting the 23 Brent crude forecast to $81 a barrel from 90. This follows Goldman Sachs and Jeff Curry doing the very same thing over the weekend, going from 95 to 86. That is their Brent forecast, Tom, going into year end. So we come down from triple digit and all that stuff, conversation from the 90s and now down towards the 80s with prices in the 70s.
You know, I've got on the coffee table at home, right next to the coffee table book, How to Raise a Happy Dog, the JP Morgan oil forecast for a year and a half ago, where Christian laid out an over $100 barrel pricing based on EM demand, based on just a global demand. We just heard from Amrita Sen the idea she believes the demand math is wrong, the market's taking it wrong, and demand's much better in a Christian Malik kind of way. And I'm fascinated here to see if we swing and get the demand that Amrita Sen perceives, or maybe Christian Malik sees, and we go beyond that 81 level, back out to 90 and back up we go.
This market enjoys making a fool out of people.
Oh, yeah. Oil's the worst. Yeah.
This oil market makes a fool out of a lot of people.
The only
Lisa,
one
that list is growing, isn't it?
It is. And so I feel like now that everyone throws in the towel, now we can see some real fireworks.
The only one I've ever seen always right about oil is Paul Sankey. He's never been wrong.
And when he's wrong, he admits he's wrong.
Yeah, he's never been wrong.
Oh, he's just never wrong.
Sankey's never been wrong.
He's never wrong. Is that what Paul told you? Equities right now positive 0.2%, 4-day winning streak on the S&P 500. Can we make that 5? Chairman Powell might be in control of the fate of that a little bit later on this afternoon.
Thank you for bringing this up. Did you see a chart in the last 24 hours in the zeitgeist of like after every Fed meeting, we go flat, 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 boring, 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 and then somewhere in question 42, McKee or
big
Colby Smith
upside.
or,
Let's be clear about that. We've had some big market days in those news conferences.
Yeah, but then Steve from the Death Star, they ask something and down we go. Am I right on this? Isn't that the summary?
You're saying that Mike helps the market go up and Steve makes the market go down?
No, it can go the other way. The next
around.
meeting can flip around,
Okay.
But don't
You're trying to cause trouble.
Don't we come out of this at 4 p.m. like, well, that was harsh?
Dazed and confused?
Yeah.
Dazed and confused?
I think so.
This one a little bit straightforward for some people, at least. In the statement, they don't hike. This is the consensus view. They skip. They consider hiking again in the future, depending on how the data comes in. And in the projections, the SEP, so it's called, the Summary of Economic Projections, they convey that there might be some work to do on interest rates. Right now on a 2-year, 467. The last time the Fed met, the 2-year closed at 380. Yields a whole lot higher. Yields a whole lot higher between the last meeting and this one. And in between, we've done a lot of work at the front end of the curve. And also in the FX market too. A turnaround in this FX market. It was all euro, 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 Europe, China, China, Europe, LVMH, Hermes by luxury, great Europe, euro dollar to 120, and it never got there. 110 down to 108, Lisa, this morning, and trying to rally as we talk about stimulus out of China.
Yeah, and as we talk about potential further rate hikes at the ECB later this week, even as there is a skip, pause, and hop from the Federal Reserve, this to me is going to be the key question. How much do they push back against the equity market exuberance at a time when there are some technological sea changes that people are trying to game out and say could fundamentally shift a lot of the growth in the U.S.? Tesla in the forefront of those, up about 2% in pre-market trading. This is the 14th consecutive session of gains, if it holds, for Tesla, which is a record streak.
Amazing.
After already adding $240 billion to its market capitalization during this.
Why? Unit sales?
No, this to me is actually truly a game changer if all of a sudden you have General Motors and Ford buying into their entire electric vehicle charging network and basically saying, you guys have it, we're going to adapt to you. This provides another leg to their business beyond just making cars. AMD also sort of getting fueled by the AI kind of trend, the other technological prowess that people are looking at. Those shares up about 3% after showing off its planned line of artificial intelligence processors. So still we are in the zone where AI is an immediate boom to stocks. And Shell, this to me might be one of the most interesting stories of the day. Shares up 2.5% in the ADRs after it increased its dividend by 15%. And they kind of moved away from emphasizing renewable energy and went back to emphasizing fossil fuels. And this is after the about face from BP. And now it's Shell basically adopting a U.S. model of saying, OK, maybe we went a little too far on this front.
A great exercise here. And I'm a big believer in select companies reading what's called the MD&A, the Management Discussion and Analysis. And a great exercise, Lisa, is to go back 2 years, 4 years, 6 years and read the MD&A at any company of what the vogue was at the time. The Shell MD&A from 6 years ago or 4 years ago or 2 years ago seems to be radically different than what you're messaging right now.
Well, and it's leading to this uncertainty. And we talked about this yesterday, John, but this question around ESG and a sort of de-emphasis over the past 6 months by a lot of shareholders in particular, particularly with respect to oil companies who are saying, just cash in.
BP, Shell, what do they have in common? Lisa pointed it out. European players. Take a bucket of European energy stocks, compare them to a bucket of US energy stocks over the previous 2 years. Last year, clear outperformance for the US players. They got the PR story. They were too busy talking to their governments, not busy enough talking to their shareholders.
Yeah, and they got the trap of the big dividend. It's unnatural across all of finance to have that dividend that they've been paying. Do you perceive Royal Dutch Shell as a Dutch company or a London company?
A Dutch company that was headquartered in London.
I'm asking.
Historically.
Yeah, I don't know.
Yeah.
Okay.
Can I talk about Disney quickly?
Please.
I wanted to talk about this.
Michael Schumacher's like he's on the edge of his seat. Is this like Little Mermaid review?
When companies start throwing out dates like 2030, 2031.
It's Draghi-esque.
It's amazing. The third installment of Avatar is going to come out December 2025 instead of December 2024. Here we go, Tom. The two other Avatar sequels pushed back by 3 years. They'll come out in 2029 and 2031. Doesn't that feel like a lifetime away? 2031. Aren't we all going to be flying then?
Exactly. We'll all be in augmented reality. Although, did you see The Way of Water? I mean, it was pretty technologically amazing.
It was very cool.
Right. So imagine that they have to then add on to that. But yeah, it seems like
Avengers movies delayed a year to May of 26, from May of 27. Star Wars pushed back a year, 2026. It's all getting pushed back. What's Bob Iger up to?
It's bigger
What's he doing over at Disney?
You know,
can you imagine being in the theatre business and you hear this in the last 24 hours? You want those movies like now.
Well, is it the writer's strike? No, it's got to be something bigger like budgeting or just the complexity of it.
How much is content no longer king, and you don't necessarily have the same kind of budget to throw at it the same kind of way?
Michael Schumacher saying, did I sign up for this? Michael Schumacher joins us now, global head of macro strategy at Wells Fargo. We're not going to look for a Little Mermaid review from him. Michael, I want to talk about the challenge of Jerome Powell. And the way I do it is what Michael Rosenberg invented with his team at Bloomberg, which is the Bloomberg Financial Conditions Index. It is 11 ratios. It is so wonderfully complex. And it shows an accommodation. I'm not going to go to the math now, folks, but all you got to know is a positive number is accommodative and a negative is a tilt towards restriction. Is the stock market hindering Jerome Powell's choice set, his degrees of freedom? Have we become accommodative, is seen by the BFCI at, I think it's a 0.079, that he has fewer choices that he can make, fewer options that he can make today?
Sure. It's a tightening cycle. That means conditions are supposed to tighten. And you look at the stock market up, 13% really since March. Granted, I know regional banks, et cetera, bad news, but still, equities have ripped. Corporate credit's doing really well. This flies in the face of banking credit conditions tightening. That doesn't really seem to add up. So I think Jerome Powell, you're right, Tom, he's got less flexibility.
Yes.
He somehow has to convey to the market, this is bad, but how does he do that? Tough.
The only way he can do it, Mike Schumacher, based on my read of history, is to delay, pretend and delay. So we're going to go through today. He's going to read all sorts of statements that are going to be, the answers are going to be written out in advance. Is this a meeting in preparation for July, hoping the facts change for Jerome Powell?
Well, they could change. The one big thing between now and the July meeting, granted, the economic data flow pretty light, but you think about regional bank earnings, they start to report, the regionals, this is, I think July 19th is the first big day. The next Fed meeting is the 26th. So it's possible you get lots of noise, let's say in the week or so ahead of the July meeting, but that seems like a long time away. I mean, heck, if Disney's delaying Star Wars 3 years, maybe the Fed can look out 6-7 weeks into the future, but that seems like a stretch.
Especially because perhaps their budget is a little bit less than the Avatar sequels. I am curious, Mike, how much we
just
have...
a little, yes.
Just a little. We've priced out rate cuts. That's what we've been doing over the past couple of months since the rate cuts priced in during the banking crisis that happened for a half a second in March. I'm now wondering, do you expect the market to start pricing in materially higher rates as one person after another on surveillance this morning have come out and said there is more work to do and the dynamism of this economy is not going to crack under 5% rates?
We think, Lisa, it's really been interesting. You make a great point. When you look at the degree to which rate cuts have been priced out for 2023, it's amazing. So early May, there was something like 90 basis points in cuts priced for this year. Now it's 15 or 20, give or take. If I look at 2024, it's about 130 basis points in cuts. We think that number goes down. Does it go to zero? No. Maybe it goes to 100, something like that. So a decent amount of rate cutting taken out. What I continue to be surprised by is why the markets are pricing so much easing by the Fed relative to other central banks. And we're talking again about next year. Or you can even look at it this year, the relative policy paths. Why is the ECB priced to hike 55 basis points between now and September, and the Fed is priced for 20? And why does the market price the Fed to be effectively unchanged at the end of the year when other central banks are priced to be much higher? That makes very little sense to us. We think the market's got that wrong.
Well, perhaps they've got that wrong, but based on what people are expecting from the Fed, they're only going to confirm that if they're going to skip. No, I mean, will that necessarily feed into some of the optimism and, as we were hearing earlier from Bruce Kasman, the exuberance in risk markets?
Yeah, the action today, Lisa, I would say is going to be all in the press conference and not in the statement. If you look at really the period of the last year, so go through the last 8 Fed meetings, very, very consistently. Whatever the market does during what we would call the statement period, so call it 2 o'clock to 2:25 or what have you, goes into a U-turn once Chairman Powell takes the mic. So he walks back some of the policy moves, tries to explain a bit, tries to amplify, maybe talks about delaying, whatever it might be. The market
confused.
says, oops, we got that a bit wrong. Let's go the other way. We're confused. So I think you'll get more of that today. So look at the press conference and focus less on the statement. That's my recommendation.
Looking forward to it. Great recommendation as well. Mike Schumacher of Wells Fargo. Mike, thank you for that. Looking forward to that in a big, big way. Got to talk about the UK as well. Something I'm hesitant to do a lot of the time. But just looking at what happened with the gilt market more recently, we're back to about 482. Yields are higher than they were at the height of the Liz Truss quasi-quarantine crisis, if you want to call it that. Had all of this drama about what would happen at the Bank of England, what wouldn't happen. And we're talking about the prospect of 6% interest rates at the BOE.
Yeah.
So let's think about what we've been getting wrong over the last 12 months. We thought that if you went to 5, economies would crack. The US, the UK, Europe, we thought they'd struggle to get through 2. And we're talking about 3, maybe even 4. So we got that wrong. And then we looked at some central banks elsewhere that had paused, started to communicate a conditional pause, and we thought they were done. Then they restarted. So we got that wrong. And now you're hearing from Mike Schumacher there of Wells, and I think this is really, really important stuff. The US is showing more resilience than perhaps other places worldwide, and yet we believe they're going to cut more than everywhere else. What's that about?
We still believe in the lag effects that have not transpired to the degree that they were supposed to. And this really is going to be the tension for the Federal Reserve. Do they still believe in the lag effects? Do they still believe in a fragility that is anything but what we're seeing in risk assets and anything but what we're seeing in labor markets? And that, to me, is the distinction between the U.S., which got ahead of some of the other central banks and started before them.
The FX market's different to the end of September, that's for sure. If you think about the gilt crisis at the end of September, 2 days from the peak in the 2-year yield, 2 days before that, cable bottomed at 103.50. Cable right now is around 125, so we haven't got this sterling issue. And there is a big difference. I think a lot of people are asking why. Why haven't we got that sterling weakness when we've got these yields higher and there's all this panic about the central bank? This is coming so far without financial instability. It's coming without the risk of policymakers making it worse through fiscal policy. Still an inflation problem. And it's coming with the full belief that the Bank of England is going to have to do something about it and can do something about it by hiking interest rates. And that's the difference, I think, between now and what took place in September.
The key thing today is the 6%. Are we beginning to frame something I hear very few people talking about, which is moving from the 5-ish short term? No one can imagine getting up to that 6% level that you mentioned.
From New York City, if you're just tuning into the program, welcome to the program. Good morning to you. Equity futures this morning on the S&P 500 positive by around about 0.1%. Coming up very shortly, David Baden of Citi Global Wealth, Mike Wilson of Morgan Stanley, Jonathan Pingle of UBS. David Baden of Citi with this to say on the equity market: highly concentrated US tech rally, masking the value still embedded in global equities following the 2022 bear market. Not the first time I've heard that this week, TK. And it's not going to be the last, because we're going to catch up with him in just a moment.
A lot of respect for David Baden, and the basic idea here is you have to participate in the market. Where? I mean, there's a whole group of people saying, I'm in cash, I'm comfortable, I'm out of the market, when do I get back in? And that, and what a lot of people like David Baden are saying is you got to be in the market, so, okay, where? I mean, exactly how much NVIDIA can anyone own?
I love that we're starting a new bull market, evidently, with all these people expecting the broadening out right ahead of a Fed that is talking about the need to really bring down inflation and a labor market. And this is the collision course that perhaps is the most underrated collision course of all year, because people have stopped talking about it. They're just like, AI, it's going to mask everything. It's going to be great.
Well, it has done so far, hasn't it?
And now everything's great.
Let's see how keen they are, how committed they are to getting inflation back down to 2%. Do they go down the PIMCO route, which is tolerate 2 point something? And if they do, and they can support growth, then we've got a different story, haven't we?
They'll deny that the whole way. It's just canon is 2%, but if they get there, fine.
That's the hope and a prayer of an equity market bull right now. Equity futures positive 0.1%.
Hard to talk about a skip. It's possible, but it's not our view. I think the Fed has 6 weeks to the next meeting. If it is actually trying to take stock of what actually is happening in terms of banking sector stress, monetary transmission, it's going to take more time to see that. But at the same time, I think they have to tell us that they have not declared victory on getting inflation down, that there is pressure for them to move more.
It's Bruce Kasman there, the chief economist over at JP Morgan, weighing in on the Federal Reserve, looking for a pause a little bit later. A divided one, though, where the committee ultimately votes not to hike interest rates. But some people on the committee say, you know what, I think maybe we should be hiking interest rates, which sets the stage for a bigger debate maybe down the road in July when they get a little bit more information and can make another call. Ultimately, they don't want to communicate just yet. Consensus view, they don't want to communicate just yet that this hiking cycle is over after starting it in March of last year.
But will he communicate it in the press conference? It'll be fascinating to see how he plays that.
The delicate dance of communication in the news conference coming up a little bit
and
later.
And frankly, Lagarde right after it is probably just as interesting.
Tomorrow, yeah.
We aim to please here, and what we do quickly before we go to Apple, John, is to actually go back and look at an annual report. We're talking about Shell, Royal Dutch. Is it Royal Dutch Shell? I always say Royal Dutch Shell, like I say British Petroleum, and I get emails.
I think RDSA is the ticker, isn't it?
Yeah, whatever. Yeah. We'll go with that. 2019, this is published, I believe, in 2020, but this is before the pandemic, let's say, to be fair. The chief executive officer of Shell. When I look at Shell, I see people with high hopes and social commitment. We wholeheartedly support the goal of the Paris Agreement. And of course,
well, that was the old CEO, right?
The old CEO. But again, in full disclosure, Bloomberg Surveillance and all of Bloomberg has been very much involved in the Paris Agreement. We were there for it. But that's what Javier Blas is writing about today, is, boy, have things changed in oil.
Yeah, the new guy doesn't sound like the old guy.
I guess so. And it's some level of black is what they're going for.
It's also a reality check as well.
Yeah.
All the happy talk about transitioning away from some of this stuff is tremendously difficult and slightly misleading for a lot of people as well. Can I get you some news out of Google too?
Please.
Here's a drinking game. How many times have you seen this headline, drink? Google accused of abusing its dominance over advertising technology to crush competition. This from guess who? The European Union. Vestager, the EU competition commissioner, saying Google is present at almost all levels of the so-called ad tech supply chain. Our preliminary concern is that Google may have used its market position to favour its own intermediation services. Hasn't this been a concern for
huge cultural,
forever?
Cultural.
Well, you know how people feel about this, so let's address the elephant in the room. There is a belief in the United States, held by a lot of people, that Europe's harsh on these tech firms because they are not European firms.
Maybe.
Europe doesn't have them.
I think
have Alphabet.
They're harsh about the
Facebook.
scope and scale of them, whether it's Apple or Google or the others. It's the mass.
Can I just say, it really tells you how much people care. Alphabet shares, Google shares down about 0.2%. It's a big yawn. No one cares.
Let's get to a $3
One day it might matter, but let someone else decide that, Tom.
Let's get to a $3 trillion question. We do that with Tom Forte, expert at Senior Research Analysis at D.A. Davidson. He got an Atari playset years ago, and now he's turned it into a Mac Pro and a study of Apple. Tom, we need an update here on the vector of Apple up 40% off the January beginning of the year. There's a persistency to the trend. What's your target as the trend continues? Do they blow through a $3 trillion valuation?
Yeah, so maybe the word of the day is pause. So I think Apple shares are going to take a pause here. I think the good news from the new product launch, the Vision Pro, which is the most significant new product launch since the iPhone in 2007, is priced into the stock. The stock's trading at a premium on an enterprise value to EBITDA basis, on a PE basis, and on a sales to EBITDA basis. So I think the good news is priced into the stock. I'm looking for shares to take a breather.
The core unit thing is the iPhone. I believe there's a new iPhone language coming out, maybe a new iPhone chip. Can they keep innovating the iPhone to keep the unit sale persistency going?
The answer is yes. But on a near-term basis, what does success look like for Apple? And it looks like low single-digit sales growth, definitely not double-digit sales growth. So you have a stock trading at a premium multiple relative to its history. The iPhone's doing amazingly well in a challenging macroeconomic environment, taking advantage of the networks, leveraging their 5G networks, Verizon and such, and helping consumers buy the phones, subsidizing them, Apple offering buy now, pay later, all these different things. So yes, iPhone can carry the day, but I think a lot of this good news is already priced into the stock.
Tom, will Apple use artificial intelligence and ChatGPT type of technology to make Siri better and to make it a more sort of intertwined aspect of the iPhone?
The answer is yes. And I think that when we started the discussion of artificial intelligence, so I've published 25 papers on the convergence of tech and retail. One a couple years back was on the power of artificial intelligence. Apple, I think, appropriately discussed that it was a horizontal technology, not a vertical one. It makes all of its products better. Hopefully it'll make Siri better.
We're also talking about augmented reality, and you talked about the Vision Pro, the $3,500 goggles that people can put on and experience a new and improved world. What is the future of this? Is this the future of computing? Everyone talks about how this is revolutionizing things in a way that the iPhone did, but we're not really understanding the implications. Can you give us the sort of market case, who wins and who loses?
So I'd like to think about it in the view of the metaverse. In our views, the metaverse will be a thing, not the thing. So 10 years from now, consumers will be accessing the internet in many different ways. They could have implanted chips, which is something Elon Musk is working on. AR, VR will be one of many ways that consumers will access the internet, but we don't think it'll be the dominant way. I do think the winner on the $34.99 Vision Pro is Meta Platforms, which is offering a device for $499. So to the extent that Apple gets people excited about AR, VR, I think Meta Platforms stands to benefit with a much lower price point item.
We had on Abby Joseph Cohen from Columbia University, formerly a partner of Goldman Sachs, yesterday, and she said she's been talking to computer scientists, and her sense is that perhaps people are overly optimistic about the future of artificial intelligence and what some of these ChatGPT technologies can actually achieve reliably. Do you agree with that? Do you feel like it's been sort of overplayed, at least to this point?
So my concern about it is you know, as a consumer who grew up with Skynet, but my primary concern is what happens to all the displaced workers if we truly become a fully automated or much more automated society. So what's going to happen to the economy if 25% of the workforce is displaced by automation? So yes, I think that there's way too much hype on what it can mean. I simply think of machine learning as the ability to decipher what is a cat, what is a dog, things of that nature. I think the chat for customer service is flawed. It may always be flawed. A chat for search has elements that are flawed. It may always be flawed. So I think artificial intelligence is a very important technology used responsibly, but I think there's going to be a lot of challenges, including an increase in automation and a displaced workforce.
$34.99 makes it sound cheap. $34.99. $3,500, Tom. How are people going to pay for this?
3.5 large. How about that, John?
It's huge.
So basically, if you look backwards, we could see why Apple's done the credit card, buy now, pay later, things of that nature. I'm of the belief in the future, Apple will offer you a pure subscription. For $250 a month, you get Apple. What does that mean? You might get a Vision Pro headset. You might get the latest iPhone. And then if you're paying $250 a month or whatever it is monthly, you may not think about the $2,000 you're paying for the iPhone, the $3.5K you're paying for the Vision Pro. So Apple, as a monthly bill, it'll be a big bill, but then I think it'll be easier for them to sell some of these higher priced products.
Tom, I've got to squeeze it in. That's been developing with the headset already. What does that mean for the valuation of the company as you start to get more recurring revenue in that fashion?
Well, it meant a higher multiple. So the beauty of Tim Cook's leadership has been the higher multiple he's achieved by adding services to a strong base of hardware. The question is, will they be able to complement future hardware and services offerings to massively increase the sales base and then on a higher multiple increase the stock? And right now we're taking a wait and see attitude.
Bingo. Tom, thank you. Tom Forday of D.A. Davidson at the end there. People have been talking about this for a while, Tom. I think that I had that conversation with you 7-8 years ago about hardware as a service, recurring revenue. Then you start to spit that kind of money off and you get a better valuation.
I'm going to go Peter Lynch 101. Walk wherever you walk, dine, live, whatever. How much Apple product was in your eyesight? You're walking down the street. How many people are glued to their Apple iPhone as a physical entity? They've been able to maintain margins, even with the single-digit revenue growth. And I just looked up the COVID cash flow from pre-COVID. They've gone from $58 billion to $100 billion in free cash flow. That's just...
What's the family subscription going to be, Tom, for the headsets?
Oh, don't get me going.
The AirPods.
$34.99.
A month.
$3,499, yes.
A month. Equities up. Mike Wilson, Morgan Stanley. Coming up in about 10 minutes.
We're selling rallies and buying dips.
There are investment opportunities to be made, to be identified in the context of growth slowing down.
Ultimately, the next couple of years are likely to be good for equities.
The US has got an inflation challenge. I don't think the fight is over.
Inflation is coming down. It takes pressure off of the Fed to continue to raise interest rates.
This is Bloomberg Surveillance with Tom Keene, Jonathan Ferro, and Lisa Abramowicz.
Good morning, everyone. Jonathan Ferro, Lisa Abramowicz, and Tom Keene on radio and television. Fed Day, our coverage at 2 p.m. We're going to start at 1:30 this afternoon. There's so much to talk about, but spirited conversation in this hour. And if you are in or not in the stock market, stay tuned. David Balin to be with us here in a moment with Citigroup. He's nailed participation in the market is necessary. Somebody brought it up, you, John, Lisa, earlier, and it's real simple. It's a bull market. Does it matter to Jerome Powell?
Skip, pause. It's not the end. That's what they want to communicate today, according to so many people. They might take a pass on hiking interest rates at this meeting after hiking interest rates for 10 consecutive meetings over at the Federal Reserve. Numbers matter. March 16th, the Federal Reserve hikes for the first time in this cycle, March 16th of 2022. The S&P 500 closing that day at 43.57. Closed yesterday, 500 basis points later, three bank failures. All this conversation, talk about recession, closed yesterday at 43.69.
And what's fascinating is, the Fed is like a great marriage, folks. We got to be focused on this. I mean, the fact is, a great marriage has no dissent. And, John, we've got no dissent at the Fed today.
You might get some dissent a little bit later, and potentially from Fed presidents, but maybe from a Fed governor too. We haven't had a Fed governor dissent, and thank you for the team here at Bloomberg for coming up with this stat, since 2005. 2005, right. TK, it's been that long. Well, Chairman Powell welcomes some dissent today, just to communicate to people that there are some people on the committee that would like to hire.
Literally, where he goes to people, I agree. He will literally go to them and say, if you want to do it, this is the time. Lisa, your observation here on, again, futures up 6. There's a terrific bid to the market. NASDAQ up 0.2%. And you mentioned earlier all the gloom about real estate and banks. Bonds do well on a spread basis.
And you are seeing this rally persist. I just want to bring you this. Andrew Hollenhorst of Citigroup, who's been pretty consistent saying that the Fed will probably hike at 25 basis points, put out a note basically saying, okay, they might skip, but it's the wrong decision. It means they are not data dependent. And he writes, a, quote, surprise Fed rate hike has not been seen since the 1990s, but the biggest Fed policy surprise in 30 years might be appropriate given the highest inflation in 40 years. And this is the tension right now in markets.
Well, that's what we see here. And of course, there can be events that make us more optimistic. Is this an optimistic event at this moment, John?
Here's a headline from the U.S. State Department. Secretary Blinken to visit China and the UK June 16th to June 21st. So get that in the diary. June 16th to June 21st. Secretary Blinken to visit China and the United Kingdom.
You wonder, that's an interesting combination there. You wonder which meeting will be more stressful.
I imagine based on recent events, it's going to be China. Bear in mind that he was set to go to China, and then we had the secret spy balloon, which was not so much of a secret since we all saw it flying through the air, and China said it wasn't a spy balloon. They said it was the weather. And the administration confirming it was a spy balloon.
A lot more complex.
The issue is, and the issue I had with the situation at the time, is that it wasn't the first time a spy balloon flew across the United States from China, except this was the first time we all found out about it, and Secretary Blinken was going anyway. So he had to cancel his appearance in China because we'd all seen it. Right. And now he's going anyway, which is hardly a shocker, is it? Because he was going to go anyway knowing that these things were happening. So, it's just one of those ridiculous things where sometimes you're managing foreign policy for domestic PR purposes, TK, and I think that was a great example in the last couple of months.
No, domestic quiet is a good and beautiful thing. Let's do a truncated data checks. John, stocks are up.
Stocks are up and have been for the previous 4 days. Can we make it 5? On the S&P 500 up by 0.1%. Going into the Fed a little bit later, the dollar weaker, yields just a touch lower. The 10-year, 380.95.
An important conversation now for Global Wall Street to reset to the mid-year. David Balin joins us, Chief Investment Officer, Head of Investments, charge of the bull market at Citi Global Wealth. Your creed, David, is you have to participate. You have to be in the market. Speak to people now who missed this leg from October. Speak to people who are comfortable in cash.
Well, if you're comfortable in cash, then you've really missed the whole message about what's going to happen in 23, 24, 25, when we're going to go back into a higher growth mode, having come through what is now a rolling recession. And it's very tempting to leave your money, in cash at 5.25%. Or in a money market fund, and then take a look at that return this year versus what's happened in the market, right? You've probably made 2% in your money market fund so far, but you would have made between 6 and 11% in a normal portfolio. And when no one can predict what markets are going to do, you don't want to be out of those markets. That's why you have a core investment portfolio, and then you can trade opportunistically around it. This has been the case of that. No one would have predicted this market doing what it's done for the last 2 months. But I think it's clear now that market timing is a very bad idea.
Well, at this point, people are wondering how much the Fed's going to care about the exuberance that some people see in certain stocks, and maybe that will start to broaden out and has already. How much do you see the rally as being really susceptible to a shock from a Fed that may not be done that might actually go quite a bit more?
Well, you have all done here, right, and everyone media-wise has made it very clear that we were going to have a recession. It's so been well telegraphed, and the discussion around what the Fed's going to do has been wildly...
Are we blaming the media?
I'm not blaming. No, it's not a question of blaming. It's not a question of blaming. It's that we've telegraphed what's going to happen. We've been discussing hike or not hike, right? And the truth is that what's going on now, right, and this is partly, what's happened with AI, but partly what's happening in that some industries are shrinking, some industries are growing, right, and that inventories are coming down, and we're having the recession even as we're having other parts of the economy grow. And that's what led us to think that when we get to 24, we're going to be a greater growth environment with earnings in general going up. The market, you can begin to see it broadening now, right? First, it was just 5 stocks, 7 stocks, 10 stocks. Now you're seeing the S&P 400, the S&P 600 moving up. And that, to me, is an indication of the broadening that's indicative of what's going to happen in 2024.
This implies that we've seen the bottoms. And with respect to earnings, with respect to any sort of downturn that might have percolated into a revolving rotation of sectors. How much does the Fed kind of kill this, right? I mean, we were talking earlier about the collision course of the Fed versus the markets and versus the fact that inflation is not coming down as quickly as they think. Do you see this as compatible, or is this a collision course it's going to have to resolve in a messy way?
Well, the collision course is really what the Fed wants to do, right? Which is it wants to lower inflation, which has gone, by the way, from 9% all the way down to 4%, right? So it's already coming down. We have, now we have rents rolling over, right? And really what the Fed's last stand is going to be is about wages, right? That's what they're going to focus on. And so I do think that they're going to cause us to have unemployment finally at the end of all of this, which is, the recessionary sign that we're looking for. It's taken a very long time to get there. The market has been very resilient, right? So I don't think that these are incompatible, right? I think we're going to have earnings rise in 24. I think we're going to have slightly higher unemployment. We're going to have a very shallow recession, and that's what's going to happen.
Portfolio 101, this is a Peter Lynch phrase I'm stealing. Is diversification your enemy right now? Should you have a more focused portfolio or utilize diversification?
Tom, this is the sort of market for diversification. You want to have a great bond portfolio, right? You can extend your duration, extend your yield, and that will then serve as a cushion when equities go down, which is what it's supposed to do. You want to be entering new parts of the market, non-U.S. stocks, small and medium-sized stocks, the smaller parts of the growth market in the United States. You want to get exposure to Asia if you believe the dollar is going to fall. All of these on a relative value basis are better than owning the S&P. But the total market value, right, of doing that, right, is at the end of the day a stronger, more resilient portfolio.
I'll take the phrase to go to the total value of the S&P, or John, the Dow Jones Industrial Average. But far more, our audience is not looking at that. They want to know, should they load the boat on Apple and its brethren?
Well, I mean, I think that that result is sort of behind us, right? These stocks are very fully valued on on many different bases. But the stocks, the next group of trillion-dollar companies, the next companies going from 100 to 200 billion, are right there, and they're going to be much broader set of companies that are going to be impacted by the efficiency associated with what AI actually does. It's going to take years for that to happen, but you can begin to project it across industries, that employ, white-collar workers, low and medium wage workers, where there's going to be real value added to those companies.
John, I didn't know this. Apple, 31 multiple. That's how it's rushed away. I thought it was a 24, 25.
UBS cut to neutral this week based on some of that.
Wow.
Based on some of that.
Just stunning.
Dave, and I always roll my eyes when people say things like the media and recession. It drives me insane. I'm a sensitive guy. I'm emotional.
I wasn't sensitive, but I wasn't faulting the media. But the government has gone out and talked about the recession so far in advance that people began to plan for it. They began to reduce their CapEx. They began to rationalize when they were going to spend money. They knew it was going to come, and they've actually been able to hang on to higher prices. Many companies, even planning for that.
If you mean, does the media shine a light on bad calls from economists on Wall Street? I totally agree.
Right, and CIOs too.
I'm guilty of it every single day. Every single day. David Baden, I'd never say that about CIOs. They're brilliant.
That's okay.
Of City Global
They
Wealth.
have them. They don't make
Sharp
mistakes.
today. No, look, it's been tough. You know, look, just because people got the recession call wrong doesn't mean that it will always be wrong. And this is the reason why I think this market is saying they're sick of talking about recession. Doesn't mean it goes away as a risk.
It's been this like 12-month rolling forecast. It's 3 months away. It's 3 months away.
Well,
it's always 3 months away.
Yeah,
you know, it's that. It's like next quarter.
Yeah,
deal with it.
Jamie
you know,
Dimon,
next
5 years.
quarter.
5
Jamie
years.
Dimon, it's always 5 years.
Yeah, there you go.
notice that about Jamie Dimon? It's always 5 years. He's asked, you ready to go? It's like 5 years.
Yeah,
5 years.
I would go with that.
I used to play this game with Ivan Glassenberg at Glencore, and it was like he'd do the same thing. It'd be like 5 years, 5 years, and ultimately someone else decides in the end. Keep saying 5
Balin
years.
has lifetime tenure, but seriously, you wonder, not to make a joke about it, but the people that have been bearish, when do they change their tune? I mean, what is the mechanism to escape from a bearish call?
So we've mentioned JP Morgan. I think that's the conversation that I'll be having with Bob Michael in the next hour. This cash trap that we've been discussing, it was so attractive at the start of the year. Finally, right? Cash wasn't trashed, 4 or 5%. Let's go. Great. Then stocks just ripped, and you're sitting there mid-year after being in cash all year, and you're thinking, 1-800 David Baden, I need to put some money to work in the equity market. And that's why this conversation about an equity market broadening out. It's where it's coming from. Because it sucked the capital away from money market funds.
I've gone back to the analog of 75 up to 76, and then a second leg up from there. I'm not saying it's going to happen, but that's the constructive debate into July.
To quickly answer your question, how do you move away from a bearish view? AI. It changes everything. I'm going all in.
Done. I'll say this about...
Put on the thing.
One
last
word on money market funds. Just remember that a lot of people in fixed income have an incentive to tell you can make better money elsewhere, because the fees on that stuff, not great. You can attract all the capital in the world into your money market funds. You need to get that money to go somewhere else. That's my word on that. From New York City, if you're just tuning into the programme, welcome to the programme. Equity futures this morning on the S&P 500 positive by 0.1%. Coming up in the next hour, Bob Michael of JP Morgan alongside Greg Peters of PGIM, Victoria Fernandez of Crossmark, all of that taking place. Going into the Fed meeting a little bit later on this afternoon. Hike, skip, a pause, Bramo. I think we're all on the same page at the moment. The consensus view is that they skip and take a pass later this afternoon.
The question now moves on to, are they done? And it also moves on to, okay, we've priced out rate cuts. How much more do they have to do if the long and variable lags are not necessarily as significant as people previously thought? And I think that really is the new conversation. Markets have moved on from the banking crisis. I don't know that the Fed has yet.
Yeah.
And when they do, how much does that shift the rate discussion?
Such a great point. And we still haven't answered this question.
You never say to me it's a great point.
Well, because sometimes it's not.
Okay, thank you.
The long and variable lags, just how long are they? Are they like super long, 30 years long because rates are locked in and everyone's got those? I say everyone.
Should we have a drinking
game? I want
game?
one of those 30-year mortgages.
Exactly.
Plus or minus 3 minutes, should we have a drinking game in a press conference today of when the chairman mentions
skip?
Long and variable
long
legs?
And variable? Maybe.
Could make it fun.
Maybe. Look out for Mike Wilson with his bear case on equities and earnings in just a moment. Looking forward to that conversation. It is about 3 or 4 minutes away. From New York City, equities higher on the S&P, positive by 0.1%. This is Bloomberg.
At the beginning of the year, we called for recession coming, and we called for persistent inflation. We're going to see evidence of that very, very soon. Recession is, is coming, but maybe already here, right? But the bottom line is there are investment opportunities to be made, to be identified in the context of growth slowing down.
Whaley of BlackRock there with a key phrase, persistent inflation. That's where we're going to go right now. Lisa Abramowicz and Tom Keene with you here as we move to a Fed meeting. 2 p.m. this afternoon, we'll have special coverage for you. I want to revisit here before we go all equity all the time, Lisa, the bond market in the disbelief, forget about persistent rates, but the vicinity is mentioned in the United Kingdom today of the dreaded word 6, of getting from 5-point excess on short paper. No one's modeling that it could go to 5.5 or 5.6 or even touch a 6 handle.
March 1st of this year, people were talking about the potential for 6% rates. Now they're not, because banking crisis. And yet everyone's moved on from banking crisis and moved into some of these regional bank stocks. So at what point does the Fed either lean into banking crisis, credit contraction, some sort of significant lag, versus this feeling perhaps we need to revisit the belief in that dreaded 6 handle or potentially much more restrictive rates?
Something to worry about. And if you want to worry, you can look at a bull market effort right now. We're seeing many houses adjust higher. At the Morgan Stanley shop, they are not. Michael Wilson is CIO, Chief U.S. Equity Strategist at Morgan Stanley. And one of your themes, Mike Wilson, is there's a complete misguess on the interstate game as addressed by the Fed today and followed by your Ellen Zentner. Wei Li there of BlackRock says persistent inflation. Is that a core reason for your caution in the equity market?
No, it's actually not, Tom. In fact, our view is that inflation is going to come down. And while that potentially is very good for bonds, it's not going to be good for stocks because that's where the earnings power has been coming from, right? This is really our boom-bust thesis. The reason we were so bullish in 2020 and 2021 is because we expected inflation to drive a profits boom. And now when inflation comes down, you're going to have a profits recession. So that's really where we're differentiated from an equity standpoint. You know, Ellen, as you know, is looking for a pause today too. She's not looking for, you know, any more hikes really the rest of this year, but a very slow path in terms of cutting next year.
What are you looking at going forward in terms of client responses, how they push back against the bearishness that you've been expressing?
Yeah, look, I mean, we're in a weird situation now because I feel like on the fundamental side, our earnings call has been spot on. So a year ago, just to kind of remind listeners, you know, we were calling for an earnings recession and we were somewhat dismissed. But of course, now we're in one. And the only difference now is that we're just saying it's going to persist. Whereas I think most people, the pushback is, no, the earnings recession is over. And we're going to see a reacceleration in growth in the second half of the year. And that's what the consensus is forecasting. So that's what the pushback is.
So in other words, you're saying that you got it right if you strip out some of the big tech names and that there was an earnings recession that played out in lower valuations of some of these shares. And you're saying it's going to continue, not necessarily talking about the headline level of the S&P as much as these particular stocks fighting against the idea of a broadening out of the AI rally. Is that correct?
Well, actually, the technology stocks had the biggest earnings recession. I mean, you know, you look at the communication services and some of the technology stocks, their earnings were down significantly in the fourth quarter. That's why they sold off so sharply in the fourth quarter. So they had an earnings recession last year, and the presumption is that's over. And now that's going to reaccelerate. And that's where we disagree. We think that including tech, not just tech, but overall the earnings recession is going to persist into the second half of the year. It's going to get worse before it actually improves next year.
If we get a Zentner economy or Ed Hyman moving down to 3%, dare I say under 3% inflation, David Rosenberg up in Toronto clearly in that camp as well. I'm thinking of the partial differentials on the income statement to get to the Wilson earnings call to get to 3,900 or whatever on SPX. And to me, it's all at the revenue line. And that is the core of your call with your security analysts that revenue growth will disappoint.
That's exactly right. So last year, the earnings recession I just referred to was all a cost issue, right? These big tech companies overinvested, thinking the pandemic boom was going to continue at the same pace. Of course, it did not. And that was a problem for discretionary, consumer discretionary, as well as some of the financial companies, et cetera, companies that overinvested. Now, what we're going to see is the top line disappointment. Okay, maybe it's not a recession, but like Ellen's forecast is 0% GDP growth effectively. That's going to feel like a recession because your pricing is going to evaporate. And we're seeing that now in goods. So there's this big dichotomy between goods inflation and services inflation. I mean, goods inflation is back to the 2% level. In fact, it's probably going to go deflationary for a lot of businesses. That's your revenue growth disappointing.
How do you allocate here? Do you participate in the market, or is cash a very comfortable place to be?
Both. So, you know, and look,
that's a strategist answer, both.
Yeah, on one hand and the other hand, right? So take my economist hat. But look, I mean, in all seriousness, I mean, cash offers you a great risk-adjusted return. We're overweight cash. Okay, there's nothing wrong with that. But we still are fully invested in equities, too. We're just underweight our normal allocation. And we've been that way for the last 18, 24 months.
I think this is misunderstood, Lisa. I think people look at Wilson, they go, get out of the market. And this is a hugely important issue.
Every time he comes on, he says, I'm fully invested. It's not a matter of just simply hiding under a mattress. My question is, what happens if there's a recession and nobody cares? What happens if there's an earnings decline and people shrug it off and say, well, look to the future and there's going to be this incredible American exceptionalism, and where else are you going to put your money?
Well, this is our story for 24 and 25, right? This is why we're in a difficult situation right now, where we see the near-term risk-reward as lousy. But if we look out 24, 25, this is what people are getting excited about. Capital expenditure boom for things like reshoring, green energy, traditional energy, retrofitting buildings, et cetera. And now, of course, AI. So this is exciting. The problem is it's a cost first, and then it's a productivity benefit.
Well, people are looking past it. I mean, this is sort of the frustration when people say that there's a divergence between bond markets and stock markets. They say, well, the bond market's looking at the now. It doesn't look very good. And stock markets are looking to 24, 25. What's to make them look at now, right? What's the catalyst to bring them down at a time when people can look past near-term pain and see what you're seeing?
Well, typically it's price. Okay, so we're very disciplined on price. We always get kind of categorized as the perma bear, but I remember calling the low in October. We called the low in March of 2020 because of price. So we're very disciplined. Most people are not disciplined because of FOMO. And that's just the nature of markets. Markets are momentum driven. It feels better when they're going up. It feels better to buy things when they're going up. And that's where we are now. So the risk reward in the short term is lousy. So I think it's going to be price, Lisa, which will change people's minds. Now, we could be wrong. Maybe we don't get a fatter pitch that we're hoping for. But we're also not worried it's going to run away from us. And we can buy the stock market kind of right here, probably 12 months from now.
What's the market bet right now? Because I see a lot of indicators that say people are comfortable with Mike Wilson's calls. They're really afraid of this bull market, and they're cautious. What is the bet that Morgan Stanley sees by the investment public, by the hedge funds, by long-only buy-side institutions?
Well, I mean, I think once again, our view is I'm in a position of luxury. I don't have to put capital to work every day for monthly performance. We have asset allocation, which is kind of measured on a longer-term basis. So I have the luxury of time, right? So our asset owner clients have that advantage. And that's what we try to take advantage of. Folks who don't have the advantage of time have to kind of participate at the worst possible moment. And that, by the way, it also includes at the lows, right? So the opportunity that was created in March of 2020 is because people were being forced to divest, and we were happy to pick up those shares at cheap prices.
What do you think is the most overpriced aspect of the S&P right now?
Well, I think this is an interesting question because most people assume it's only 10 stocks. That's actually not true. The median multiple for the S&P 500 today is the same as the market cap weighted multiple. It's close to 19 times, 18.5, 19 times. So it's a very broad overvaluation. Now, I would say the sectors that are cheap, okay, the only ones that are appearing cheap now are energy and financials. The question there, of course, is what are the earnings going to do? Because they're cyclical businesses.
Well, focus on energy there. You got 20 seconds of energy there. Is that the place to be?
Well, I think energy at the stock level, there's definitely opportunities. And in financials too, right? So like the regional banking crisis created opportunity in individual financial services stocks. And I think that's what we're trying to do now. We're trying to find these one-off opportunities as opposed to worried about the stock market overall.
Mike Wilson, thank you so much. With Morgan Stanley here with a call. 3,900 is where you are now. You want to make some news here?
3,900 year end. Yes, sir. We're still there.
Okay. You're going to let us know if you change any
be the first call.
Absolutely. Mike Wilson, Morgan Stanley here. This is what it's about. It's about a market of opinions, and it is extraordinary right now.
It is extraordinary, especially to parse through what the reality is. Is it just 10 stocks, or is it broader? What are the valuations that matter at a time when there is such a bifurcated kind of market?
19 is the multiple Mr. Wilson talked about, and I look at Walmart at 24 times and go, oh, really? Please stay with us. It is Fed Day, 1:30 this afternoon. We'll be with you. Bloomberg Surveillance, Lisa Abramowicz and Tom Keene. Thank you for joining us on radio, on television. Of course, the great partition here between the Consumer Price Index and the PPI is with CPI. You've got two things to look at, core and top line. And with PPI, the great tradition is to look at three different items that have been amended over the years. There's only one person I know expert on CPI, PPI, and EIEIOI, and that is Michael McKee, that'll help us with business inflation right now. Mike?
Good morning, guys. Well, the EIEIO index is out. PPI final demand falls 0.3%, which is quite a drop for an index that was up 0.2 the month before. I'm sure waiting for the details to drop, but I'm sure that's probably energy related for the most part. The energy, the core rate, ex-energy, food, and trade comes in flat at 0.0%. That's down from a 0.2 gain, and both of those numbers are below what analysts had expected. The year-over-year final demand falls to 1.1%. Let me get you in a second historical on that, and the core falls to 2.8% for the year. So we are seeing a big drop in prices at the wholesale level. Now, of course, Tom, as you mentioned, they don't translate directly into consumer prices because the middleman gets in there and has some say about what things cost. But it is a sign that the lower level price from the bottom up prices are starting to fall backward, and it would just reinforce the Fed's idea that maybe they pause today.
It's interesting to see. I'm going to do the markets right now, Michael McKee, while you parse into many, many pages there. Lisa, help me out here. In the equity markets, there is a lift, but not all that much. I don't want to overplay that. In the bond market, it's a boom moment. The 2-year yield comes in, slams in nicely. 30-year bond even comes in again. But what I've really got here is a readjustment on the 10-year tips from a 1.60 down nicely to a 1.57 handle, and currencies really move.
Yeah, looking right now at the euro versus the dollar, and you could see it pop on the heels of this, basically this belief that the ECB on Thursday is going to raise rates. And this just reconfirms the idea that the Fed is not going to move today, and potentially that this disinflation will gain steam as time goes on, which I think a lot of people in the equity markets seem to kind of be holding on to.
The DXY index, there's two dollar indexes. DXY, the traditional index, which is very euro-weighted, 54%, I believe, euro, and that slams down as you see that strong euro, and even Bloomberg dollar index moves as well. The Bloomberg Financial Conditions Index moves to a more accommodative stance as well. I mean, this is, I guess, to script. And as John Ferro mentioned earlier, Lisa, you wonder if this is where Powell begs for dissent today to make it truly asymmetric versus makes it symmetric versus an asymmetric certitude about rate cuts to come.
Here's the issue, though. This is in the goods sector. We knew that there was disinflation in the goods sector driven by energy. Services in the labor market really has driven the other side of it. So how much are they going to really emphasize the need to see some more disinflation on that front beyond anything you see in the goods sector?
Michael McKee, looking at the various stages of wholesale business pricing. Mike, it used to be easy. There was like the beginning of the factory, the middle of the factory, and final demand, what came out the door. You've lectured me. It's more complex today. Which part of PPI has your attention?
Well, Tom, we generally like to look at PPI for final demand, trade services and energy and food, because that's essentially a core rate. The trade services is not trade in the international sense. It's basically the margins received by wholesalers and retailers. So you get a picture there of what's going on at a lot of companies. Now, the decline in the overall final demand number was, as I said, due to energy prices. Gasoline prices down 13.8%. Energy prices in general down 6.8%. Food was down 1.3%. Remember when food was a big part of the CPI, so we may be seeing some benefits there. Services moved up 0.2%, but that's down from a 0.3 the prior month. So maybe service prices are starting to come off a little bit. And I'll leave you with one interesting number here. An index for iron and steel scrap fell during the month. Remember when Alan Greenspan was chairman of the Federal Reserve, he used to look at steel scrap as an indicator of how the economy was doing. It's where you sell your old refrigerator or your stove. They melt the steel down and make it into something else. And if prices are going down, there's less demand for steel. And that means the economy might be slowing. It's an interesting concept to follow. I'm not sure if it's so accurate these days. We haven't looked at that in a long time. But it did pop back into my head, this remnant from the Greenspan days.
Michael McKee, thank you so much. Again, the bond market moving here in 4 basis points and the 2-year yield 4.6 0.63%, 3.80% on the 10-year yield. At Chapel Hill long ago, Jonathan Pingle studied all of the different Greenspanian details and data on the economy. He joins us now, the chief American economist at UBS. John Pingle, I want to cut to the chase, which is to try to recalibrate how far or how close we are to recession. That's the great central bank hope. Is the recession in the distance?
Well, I mean, when I sort of look at the data, and I can go back to the Greenspanian sort of indicators like rail car loadings, which actually have fallen a lot. But we are starting to see some of this weakness in demand. Lightweight vehicle sales fell in May about 5%. Even in the CPI data, we've seen 2 months now of new car prices declining. So we'll see what we get on retail sales on Thursday. I mean, tomorrow, we are expecting a rather weak headline number. And that could be indicative of consumers starting to come under a little pressure as they, spend out their excess savings. Student loan payments start to resume, as well as still feeling the weight feeding through from the lagged interest rate increases from the Fed. So we do expect in the second half of the year that the nation's probably going to tip into contraction.
Jonathan, I've been struck by the fact that every time someone starts to say, we're going to see the savings run out, we're going to see the consumer start to show more discretion, somebody else pops up and shows an example of how that's absolutely not the case. And I'm thinking about Wells Fargo CFO yesterday coming out and saying that card spending was up about 10% in April and May. Despite this discretion, how much is this rolling ball of money that keeps flooding into different sectors of the economy just going to roll to another place, but not necessarily go away?
Well, that's certainly been a big part of what we think has kept consumer spending elevated. Now, I mean, real spending over the last 3 months of data annualized is running just 1.1%. So, some of these year-over-year increases are going to look quite gaudy, particularly nominally when we've had a lot of inflation. But if we look at kind of what's happened since January, consumer spending actually hasn't been all that strong. I understand that the credit card data does, sort of in the year-over-year rates look pretty good. But, if you think about auto sales declining, and I think what we're going to see in retail sales released tomorrow is a bit more softness than what we were seeing, 5, 6, 7 months ago.
Jonathan, we're talking about PPI data coming in softer than expected, which is a good downside surprise for those who want to see inflation come off much more quickly than it has been. How much does this actually end up fueling corporate profits and, frankly, allow them to continue to increase wages if basically their input prices are coming down, but their output prices can stay where they are or keep going higher based on their pricing power?
Oh, yeah, no, profit margins could be having, they could be having an important component of sort of nominal wage pressures. I mean, you can imagine that, if you've got elevated profits, you're going to be much more willing as an employer to pass along wage increases in a tight labor market such as this. But, a lot of what's going to come back down to the inflationary pressures is going to be what happens in the broader economy and whether we do get a little bit more incremental weakness. To the extent that consumer spending does slow, it's going to get harder and harder to pass along price increases from the business sector. And I think that's, in fact, kind of really what the Fed's hoping for in both slowing the labor market and in slowing consumer demand growth here.
Is your perceived disinflation a comfortable linear function, or is it sort of ugly along the way? Like we go down a point and oops, and then another point and a half, oops, and very nonlinear.
No, you're exactly right, Tom. I mean, that 100%. We have some ebb and flow, let's say, to the disinflation we expect. I mean, we are expecting a pretty fair step down in the June data and the CPI to be released in mid-July and kind of a soft summer. But we are expecting then sort of a rebound in the pace as we kind of head into later in the year. But one of the things that you saw, and Mike was just talking about in the PPI, is year over year, with energy prices coming down, some of these base effects are going to start to pull down these year over year changes, and I think you'll start to see that this summer as well. Right. But in terms of this monthly pace, I'm sure there's going to be some bumps in the road.
One final question. This is really, really important, John Pingle. Just simply, does the Fed do policy based off a barrel of Brent crude, West Texas Intermediate crude, or dare I say a gallon of gas?
So I would argue no. I think that they tend to look through energy prices to some extent. Now, energy prices will feed through to core prices over time, but I think for the most part, there's not a lot they can do about the price of crude, whereas I think what they are worried about is much more the sort of wage price pass-through that risks unfolding as long as inflation stays elevated.
Jonathan Pingle, UBS, thank you so much. They're chief U.S. economist. I think, Lisa, it's really, really good to talk to these guys that really keep track of the beans. You know, there's the equation for GDP. And the basic idea here of just you got to go back every once in a while and say, what's consumption doing? What's business investment doing? Even what's exports, imports doing? And the answer is nobody has a clue. We quote this number, Atlanta GDP. We don't have a clue.
Well, remember at the beginning of the year, a lot of companies ratcheted back their capital expenditures. And we saw that consumer spending continue to hang in there and actually increase. And then all these companies who were behind the eight ball, they basically had to come out and reinvest, even if there was uncertainty. And how much is that going to prolong this cycle? And these are some of the sort of vagaries of human emotion and the uncertainty versus the reality of people still having money and spending it.
And McKee, the line of the PPI, there's like 8 lines to PPI. The one he had a revision of disinflation as well. So it wasn't just, a single statistic.
I do keep thinking about the mortgage applications earlier this morning, though.
I missed that. Tell me.
They came out increased 7.2%. So on the flip side, you see these areas that have bottomed out, like housing, starting to creep back up there as people realize they kind of have to get on it, given that they need a place to live.
Aren't we so sheltered from this because we live in Manhattan? I don't think you and I have a clue what the American real estate market looks like. I mean, I just think we live in such an oddity.
I think everyone lives in their own oddity right now. What you're seeing is each municipality is very different from one another in the U.S.
Look at the data here. NASDAQ up nicely, a little red on the screen with the Dow Jones Industrial Average as well. In 4 basis points in the 2-year yield. It's no question about it. If you're joining the program, the S&P up 1%.
Right now, I'm looking at what's going on and expectations for the Fed coming out later this afternoon. And Tom, what's your takeaway from today? Honestly, what have you kind of thought of as the main thrust of the tension at today's 230%?
The tension with 230 is going to. First of all, it is historic. And to me, the arch tension, and this goes back to just basics, which is in each and every economic report and each guest that we talk to, is how much of this is normal economics and how much of this is on a supply side nature is a basic phrase, is pandemic induced. And I would suggest Powell's going to come out early in the press conference and recapitulate that this nation is still affected by what we lived with for 3 years.
So Ben Bernanke and Olivier Blanchard put out a paper, a jointly authored paper, where they talked about how initially it was supply-side constraints that fueled the inflation and how it shifted. And now it's really being driven by the wage side, by the labor market tightness. And they talked about how that shift is making it much more difficult for the Fed because they have to see unemployment rise in order to bring inflation lower based on what the main driver is right now.
You know, my book of the summer is Olivier Blanchard. I'll get that back out here to recapitulate, get to July as well. But the basic idea here is simple. Professor Blanchard looks for other factors to overlay on top of the daily babble we talk about. And one of them is the use of technology, which goes back to what we've seen in the stock market.
Yeah, so you asked earlier, what makes people capitulate on their bearishness? They just say, AI, I'm done. I'm now all in.
Randall Krosner, Diane Swank, other worthies will be with us here at 1:30, a most interesting Fed meeting. Stay with us. This is Bloomberg Surveillance. Good morning.
I think we gain and China gain from trade and investment that is as open as possible. And it would be disastrous for us to attempt to decouple from China. I certainly do not think it is in our interest to stifle the economic progress of the Chinese people.
The Treasury Secretary of the United States, the former chair of the Fed, Janet Yellen there. And I really want to say that over the years at Bloomberg Surveillance, the one person who's driven forward this thought in conversation is Catherine Mann, now at the Bank of England. Professor Mann owns the absolute high ground on the codependencies of China with America. And Lisa, as you heard there from the Secretary of Treasury, and I think Catherine Mann, she wouldn't say it now because she's working for BOE, but Catherine Mann would say you've got to engage the conversation.
Which perhaps is the reason why Tony Blinken is heading over to Beijing, I believe, on Thursday. We're learning this as he tries to mend ties, perhaps. I'm wondering what the parameters of that are, Tom, at a time when there still is a lot of public pressure to decouple in a way that perhaps policymakers and business leaders don't necessarily feel is realistic.
The statement from State is simple. While in Beijing, the Secretary will meet with senior PRC officials, where he will discuss the importance of maintaining open lines of communication to responsibly manage the U.S.-PRC relationship. He looks for potential cooperation on shared transnational, it's a lot of verbs and syllables, transnational challenges. Joining us, someone who speaks clearer than me, Anne-Marie Horton, our Bloomberg Washington correspondent. We're thrilled to bring in Damian Sassower, Chief Emerging Market and China Credit Strategist for Bloomberg Intelligence. Anne-Marie, to you is first. This is not a surprise, is it?
No, it's not. Actually, myself and Jenny Leonard were the first to report about his trip, and now the State Department confirming our scoop with the dates of Secretary Blinken heading at the end of the week to Beijing. This is the first time as Secretary of State he has taken this trip, and this is a long time in the making. Remember, one of the deliverables when Xi Jinping and President Biden sat down in Bali at the G20 was that Secretary of State Blinken would head to China. That trip was then on the books in February, and he was still set to go when the White House knew there was this spy balloon flying over the continental U.S. But then, obviously, politically, it became very toxic when images of that spy balloon surfaced, and he had to cancel his trip. And then we had a fresh low of relations between Washington and Beijing. So now he is finally going, and likely this could potentially open the door for other such trips. Remember, I also sat down recently with the Treasury Secretary, and she said her plans were as well to still go and visit her counterpart in China.
How will he be greeted? Will it be a rote foreign policy diplomatic mission, or will you look for something more than that, perhaps like we saw with Kissinger with Nixon a few years back?
I think this is really just an opening of the window and the door and to try to put some guardrails under the relationship. I think it's also interesting at the same time this week, you have the Treasury Secretary of State heading to China. You also have Jake Sullivan, the president's national security advisor. He's in India, but he's also going to Japan as well. You can see the administration is really starting to put a lot of emphasis, especially as we already are over a year into Russia's invasion of Ukraine. They've done a lot of work with Europe. They are really starting to put a lot of emphasis on Asia-Pacific.
Which focuses a lot of people on who has the leverage. And Damian Sassower, I'm curious from your vantage point, we're talking about the U.S. making outreaches to China at a time when they're convening business leaders with urgency to try to get a handle on how to support the economy. Where is the balance of leverage here? What's the backdrop in China amid some of these potential talks?
No, I think Anne-Marie's right to point out the timing around this meeting, and the timing couldn't be more perfect considering we have activity data coming out at 10 o'clock tonight. Oh, but an hour before that, at 9 o'clock this evening, the PBOC is likely to cut rates by 10 bips. Now, here's the thing. This is all about China and CNH becoming a funding currency, right? I mean, if you look at the negative carry embedded within China, that's why you have foreigners selling CGBs. That's why you have the CNH weakening to 715. You have onshore corporates who are flush with dollars, not defending the yuan because of the policy ambiguity that's been going on, not just between China and the U.S., but writ large across, most of the developed market regime. So I think right now, given where we are, given the data that's coming out, I think China's right to make an overture toward the U.S. and try to rectify the ship.
Do you feel like, or not feel, but is the sense on the street that China right now has enough pressure on it to try to make more concrete overtures than they've made since the pandemic, when there have been some true profound shifts in policy and, frankly, social approach by Xi Jinping?
Well, we haven't seen real, action of that yet. I mean, we have heard about them convening, the PBOC Yin Gang, convening business leaders to ask their opinion on what we can do to get animal sentiments back, on the right ship in China because the economy is flat on its back. And that has everything to do with the property sector. And it seems to me this time around, China's not willing to stimulate the property sector as they have in years past. And so what does that mean? It means that they're going to have to pivot to more of an export-oriented approach, hence the U.S.
Anne-Marie, diplomatically, Are we traveling to Beijing realizing that China from Mr. Sassower is, quote, flat on its back?
Well, I think what you want to see from the State Department is they're trying to have more of a diplomatic overture. I really think this administration is trying to put guardrails on this relationship. But yeah, they obviously see the concerns that are going on domestically in China. I think for the State Department, what they're concerned about is what happened most recently in Singapore, where there's this cordial handshake between the two military chiefs, the two biggest economies in the world, but that was it. There was no real dialogue. At the same time, you had a Chinese vessel and a U.S. warship coming very close together. They want to mitigate these risks.
Right. Damien, is the Chinese banking system sound?
Well, no, not at all. Actually, I think what we've seen here is we've seen property developers. It's then matriculated into local government finance vehicles. And now we're seeing municipal governments, right, really feel the pain here. And so, for me, this is fiscal fragility in China. And I don't see it getting any better unless we see some really, really big shifts on the policy front.
I just want to say, Lisa, that Liz Economy, who's now with Raimondo over at Commerce, she nailed this. Elizabeth Economy absolutely nailed this fragility in China.
Which shows why some of these policymakers may want to come to the table with the U.S. But Anne-Marie, one thing we have consistently talked about, and I find this fascinating, policymakers and business leaders want to see the relationships mended a bit more, perhaps, than public sentiment on both sides, where you have basically catering to the population saying, we're hardening our line with the other entity. How much is that factoring into the discussions that we expect to hear coming in the next week or so?
Well, it's difficult because the rhetoric, the political rhetoric from Washington is very, very hot when it comes to China. And that is only going to increase as we head towards November of 2024. And there's a presidential election from both sides. They are going to want to make sure they are talking tough and taking a tough stance on China. At the same time, you have the administration also potentially readying new provisions and new penalties they can use on China. We've already seen this administration keep the Trump-era tariffs. They've had a number of export controls put on China. And at the same time, we're still waiting on details about this outbound investment restriction that obviously potentially can hurt U.S. businesses, which is why the administration at the G7 was trying to shore up European partners on it. So they are trying to put guardrails on a relationship at the same time that they are also looking to put penalties in some places on China, and at the same time try not to get the blowback from Republicans, especially as this is a president that's running for 2024.
Anne-Marie Horton, thank you so much in Washington. With us, Damien Sassower here on EM, and I only have one final question as we close out the hour and move forward on a Fed day as well. It is widely mandated on page 42 of my agreement with Bloomberg that there can be no Yankee garb on set.
Whoa!
You show up with a Yankee tie today?
Well, I'm not pointing fingers at the Red Sox, although we do play it this weekend. But we've got a big ace pitching matchup tonight. Yankees, Mets, Garrett Cole, Justin Verlander. It's going to be a great game. I'm going to be switching between that and the China data here on Bloomberg, the activity data.
And you'd be in the third row with Keith Olbermann. I mean, there's a must-attend game.
Legend seats only, Tom.
All I can say is you let Anne-Marie go way too early. She would have heckled me nonstop. How about those Yankees last night? I saw that, Anne-Marie.
What do you think? The Mets have lost 42 in a row.
Whatever,
you
it doesn't
talked to Steve Cohen yesterday, right?
Yeah. All I can say is don't do that again.
Okay, sorry.
Yankees Mets here on the desk as we close out an interesting hour. Sassower will not be attending our Fed show this afternoon. That is for sure. Anne-Marie Horton on short notice there on an important announcement from the State Department in Washington. Blinken will travel to China. We will travel to the Fed show this afternoon. Our usual lineup of worthies. I really can't say enough how I think it's going to be a value add. And of course, we'll be watching those markets into the close. Right now, red and green on the screen, a little bit of a lift. It's quiet before a Fed meeting. We say good morning on radio and television. This is Bloomberg Surveillance.